Hello and welcome to our audience. We have a special event for you, the uranium sector update. The cycle has turned, featuring Mike Alkin and Chilleri of Sachem Cove Partners. Mike and Tim are two key people of a very small group, in my opinion, of people around the world that have actually taken the thousands of hours needed to dismantle the uranium supply chain and uncovering really a very compelling situation that many have still failed to see with any clarity. So this event is part of the SmithWeekly Value Series. I am the event host, Andrew Weekly, founder and CEO of SmithWeekly Research, and thanks again for taking the time. We urge the audience to allocate attention to the screen shown here, as well as the event notes under the screen viewer for important notices and details about this event. Also, I'll point out that this event has been a donation of time from both the guests and SmithWeekly. We've not paid them to join us, and they've not paid us either. So sit back and enjoy. And to our guests, we have Michael Alkin here with us. He is Chief Investment Officer and co-founder at Sachem Cove Partners. And we have Tim Chilleri here with us as well. Tim is analyst at Sachem Cove Partners. We're forgoing the introductions here, as most folks in the audience already know these guys quite well, and you'll hear more about them as we get talking here. Gentlemen, welcome to both of you, and how is life treating you?
Everything's going very well, Andrew. It's we're through 2020 into 2021. It's already through January, almost here, so time's flying per usual, but we continue to plug along like we always do.
Excellent.
Yeah,
well, good to hear.
How are you doing, Andrew? How's your family and everything?
Good. No, everything's going really well, and fortunate to still be here and enjoy these interesting times in the markets and on the globe, and just life in general. A lot's changed, and looking forward to more fun and excitement, fireworks in 2021. Well, guys, we have a number of things we want to talk about here, but I guess let's start out here with just a startup question first for Mike. Mike, how do you like your coffee in the morning? And when you look at the broad financial markets today, what is your first and foremost concern?
How do I like my coffee? No milk, no sugar, so straight. That's how I like my coffee. The financial markets. It's interesting. Andrew, can you hear feedback? Can you hear beeps coming in? I'm just curious. I just want to make sure. Okay, because I have a program on in the background that a Bloomberg where I'm getting messages sent to me, and I want to make sure you can hear it. So just so it doesn't bother you guys. But I think it's a very interesting time. There has been. You can make this case. Look, all the twin deficits and all the debt that's been added on, but that's been going on for quite some time. And so who knows when that's going to eventually kick in. I do. My view on the market is I'm more. I look at the dollar. I look at the case for potentially a weaker dollar, which would square with where we are with the disconnect between commodity prices and equity valuations. Commodity prices are actually the prices are moving up, but the valuation between the two asset classes is stretched, with equities being extremely high. I don't know. I'm not a bubble guy. I don't really get into that, but I see odd behaviors sometimes, or odd circumstances in the market. Where over the last couple of years, things that I'm more familiar with, rooted in valuation, seem to not matter that much. It seems much more driven by narrative and stories, and you just need to recognize that. And if you're not comfortable playing in certain things, you just don't. For me, I'm not going to go play in things that I'm not comfortable with. It doesn't mean other people are wrong for doing it. It means that's what they're comfortable with. So, I'm not a big broad I don't have a big broad view right now. I think the market is toppy. I think there's a reason for, you've had tech fueled growth. Tech is a major component of the S&P. I think the pandemic's been a big lift for them, for big tech. Is that going to continue? Who knows? I personally think I'd rather be in more out of favor, commodity-driven type industries where I think there's less eyeballs focused on it, and it's not priced in. So,
yeah, I like that. And Tim, I want to ask you the same thing. Likewise, your morning coffee and your top consideration in today's broad market.
Yep. So like Mike, I'm actually a black coffee guy. So very simple on that front. In terms of markets, it's kind of funny. Mike and I are pretty similar. I mean, it's not a coincidence that we probably stumbled into the uranium market together many years ago just based on our lens of the world. There are people who are just much smarter than me who understand a lot of the macro pieces. I mean, I do read and try to understand what some of the macro investors are looking at in terms of the dollar, in terms of some of the dynamics at play between central banks. And there are people on both sides of that trade. I know that there are people who are strong dollar bulls. I know that there are people who are pretty convinced that the dollar is headed significantly weaker. And they make convincing arguments. And who am I to say that one's going to be right and the other one's going to be wrong? I'm just not sure. So I like to focus on what's comfortable for me, which tends to be cyclical industries. It tends to be focused on commodities just because that's also my background. Since I've come out of university, I've been in the commodity markets my entire career so far. So that's where I'm comfortable. So when you're looking at companies in some of these sectors, whether it's gold miners that are printing a lot of free cash flow, paying back debt, those sectors are much more interesting to me than, say, the FANGs of the world, if you will. So that's where we continue to focus on these niche markets. That's where I'm comfortable with, where there's a lot less eyeballs. And that's kind of how I look at things today.
Yeah, that's great. And I generally agree as well. And certainly the coffee side of things, some mornings it has to be spiked, but other than that, certainly I agree with you guys on the straight black attitude, and I need to keep my sugar down. Well, look, maybe Tim or Mike here, either of you, maybe refresh the audience on the meaning of looking at places that are really misunderstood. They don't have a crowd, and quite frankly, they're still soaked in red.
Yeah, maybe I can take that one for now. For us and for me, I personally find it a lot easier to go to places where certain people are not going to be. So, for example, a lot of the really hardcore, the Warren Buffett views of the world, the hardcore value guys, they're not going to be looking typically at super cyclical industries to begin with. So you're wiping people right off, certain sectors right to begin with, who I believe are much smarter than me to begin with. So I've just always had a lot of success by accident. It was never a plan of mine to look at markets specifically that are less popular. Whether it's because it's not being followed on the popular financial programs or various internet investing chat boards, etc. I just kind of fell into it due to my career path. Starting as a futures and options broker, working my way into a physical commodity trading position where I had a lot of success. And so I just kind of woke up one day and realized, maybe you should be focusing on places that a lot of other people are not. Because you potentially could have informational edges. There's only a couple of real ways to get edges in the market, and it's very hard to find informational edges today. And that's just due to technology and the internet, the amount of information that is spread around the marketplace from professional investors. There are a lot of even some of the amateur retail investors. I mean, you call them amateurs, but they're really good at what they do, right? You look at some of the social media platforms. There's really interesting people out there with interesting backgrounds putting out information on companies and sectors. So because of this dearth of information, there's a lot of it. So I prefer and we prefer to go to places where there's less of that because it's just so hard to get an informational edge. And obviously we feel that we continue to have an informational edge in the uranium market, which is one of the reasons why we ended up kind of going there once we uncovered the thesis, vetted the thesis and felt that there was something there. So that's kind of a long-winded way of my view on that, Andrew.
Yeah, and both of you guys have come into the natural resource sector, uranium specifically, and you've worked hard sorting out the nuts, bolts, washers, and the screws of how it functions. I'd like to know if you guys agree that due to the broader markets in tech, crypto, biotech, psychedelics, and other places, that the bulk of the commodities have a lot of runway as the market eventually rotates. Do you guys agree with that premise and that uranium has one of the best performance profiles?
Yeah, I mean, sure, we do. Well, we think that uranium's unique unto itself, right? I mean, you could lump it; it's a commodity, but it's not a commodity that has really speculation in the marketplace. It doesn't have real price discovery on a regular basis, right? There's a bullshit futures market that's out there that's just so small, it's insignificant. You basically have one cohort of buyers, and that's electric utilities, 60 of them around the world that are going to step up and buy this stuff. And then you have some traders who aren't really traders. They're just, they're book order entry jockeys that move it back and forth for a few cents a pound here and there, but they have no view, no committed capital. They're order takers. So it has its own cycle, and it feeds off itself. Now, will that catch a commodity bucket when capital starts flowing into it? Yeah, I think you're seeing that. I think when it's catching, nuclear is catching an ESG feel to it, that people are recognizing if you're going to achieve these carbon neutral goals, to get there you need nuclear power to be part of the mix, part of the conversation. Uranium money gets swept up in that. I think you're also seeing that people step back and say, hey, wait a second, if commodities have been out of favor for quite some time, and if we're dollar weak, if we're in the dollar weakening camp, that's good for commodities, and therefore, what's really cheap? And then people take a look at the supply demand situation of uranium, and they spend a little time looking at it, and they'll come to the conclusion that we did. So yeah, it has its own cycle. It's funky. It doesn't have price speculation like most others do, price discovery on a regular basis. But being a commodity, it will also catch. Not only will it have its own unique features, but it will catch the general commodity move. We think it plays zero part of our thesis, though.
Yes. Yeah, and I certainly agree with a lot of that thought process. And, there are other attractive opportunities in the precious metal, base metal, oil services, maybe a bit of coal and a few others. But I really still fail to see that, the best performance profile, I think, is standalone. And that's certainly uranium in my view.
In our view, there's nothing that comes close. It's uranium.
Agreed. And, really to sum up these sectors though, Mike and Tim, everything we use comes from either mining or growing things, and the growing things still uses things that we mined.
Yeah.
So it's just fantastic.
Yeah, and given our time, and just in Mike's as well, and yours as well, Andrew, is you see the cyclicality. You see when things get popular, when things fall out of favor. This is natural. This happens across all kinds of sectors all the time. And it might take 10 or 12 years, or it might take 10 or 15 years. But not saying that the commodities from here are going to take 10 or 15 years. But these go through cycles. And to your point, Andrew, the world.
He's not saying that, by the way.
Right. It's just that the world is looking at maybe the commodity sector as very undervalued, but we're going through COVID. But as the world returns to a bit of a more quote unquote normal or new normal, whatever you want to call it, at the end of the day, how do we get these resources to the market? How do we get these things to where they need to be in terms of the energy transition? So that's what's exciting for us, looking at, where does uranium fit within that broader view? So that's what gets us excited.
Yeah, certainly. And, look, new normal, what have you. The fact is we still need these things. And, last I checked, as human beings, we're still very basic creatures. Still need to eat food. We still need to cross the street. We still need to use the restroom. Fairly simple things. We have desires, really simple setup here. And I think the sanity does come back. Well, let's move on. Let's talk, let's get into uranium here, guys. Tim, maybe just start out by covering the supply side risks that we have before us in 2021, 2022. And are these problems making it into the off-market discussions? What are you seeing and hearing out there?
Yeah, well, certainly, 1 year ago, sitting in late January 2020, it was just coming to the fruition of what was this thing happening in the world with this coronavirus. It was just kind of hitting the wires. We weren't really sure what it was, and I don't think anybody on planet Earth had any idea that it was going to impact us the way that it has. Certainly, I was not able to forecast that. And so because of that, we obviously saw some of the care and maintenance decisions to go down, both from Cameco. We saw some potential kind of closures there temporarily in other jurisdictions as well, like in Namibia. We saw the pause of well field development and some of the activities from Kazatomprom and their relevant joint venture partners. And so as we move through 2020 and into 2021, no one really expected that this would continue to drag on, I think. And so here we are today, where we know Cigar Lake has gone back on care and maintenance for some period of time. Cameco has been, I think, pretty clear with the market in that they have specific metrics to try to ensure that they have enough employees, and that the situation, as they last stated it, was getting worse in the jurisdiction of Saskatchewan. So they're closely watching the COVID-related infection rates and all of that is happening. We recently saw some of the news coming from Kazakhstan that there were some infections at a particular JV, KATCO, which is the Kazatomprom and Orano joint venture. So the point of all this is that the risks remain out there, and I don't know, or we're certainly not saying that, tens and tens of millions of pounds might come offline tomorrow. That's certainly not what we're saying, but the risks are out there that we've highlighted to the industry for a few years now. In the past, we've seen fires and floods affect mines and mining operations. This time, it's maybe not fire and floods, but a COVID-related care and maintenance shutdown to protect workers, to protect employees. So these risks are out there. Again, we're not saying that there's going to be billions of pounds that come offline tomorrow or anything like that, but the risks continue to impact this market yesterday, today, and fortunately or unfortunately, they're going to continue to be a risk factor as we move forward in 2021. And that doesn't even include the actual, I'm sorry, I forgot to mention the fact that there are some actual mines closing permanently due to depletion. We know the Ranger mine in Australia has recently ceased processing, and that in Niger, Cominac, which is a Orano joint venture with a couple other firms as well, that after some 50 years or so of mining, that is depleted and will be closing permanently as well. So the supply, and this is all factored in the market. Everyone knows that Ranger was going to go down. Everybody knows that Cominac was going to go down, but those are pounds coming out of the market that will need to be replaced in some way, shape, or form.
Yeah, certainly. And Olympic, they're waiting for higher copper prices, much higher copper prices, to do anything there. So, Mike, along this, you keep in touch with utilities. What's your interpretation of their focus with COVID operational concerns, restocking? Do they really care about supply concerns at this point? What do you think?
It's interesting, right? So I think a lot of weight's given to utilities. Utilities are, first of all, the fuel buyers are very bright people. They're nuclear engineers. They're very smart. They happen to work in an industry that where demand and supply are inelastic, and they need it, and they're going to pay for whatever the price is when they need it. And so there's no substitute for what they need to buy, and so it will carry that course. You just have to step back, Andrew, when you think about this market. And if you go back and look at history in this market to understand how the market reacts, if you go back and look to the early 2000s, before the price of uranium was 10, 12, $14 a pound. At that time, the long-term contracting as a percentage of annual consumption was sitting in the 31, 35, 38, 39 range for many years. You had 15 years or so of oversupply. You had a tremendous oversupply party will continue narrative. You had in the late 80s, you had massive new supplies coming from the Soviet Union via the megatons to megawatts. You had the Olympic Dam project in the late 80s, early 90s that was coming online. You had MacArthur River, the richest deposit in the world, that came online in the 90s. So you saw just a plethora of supply coming online, and prices stayed low. And then as they started to wear down and burn down inventory, and as you started to come up right before the bull market in uranium of 2004, there was a tremendous amount of under contracting, not contracting their annual consumption needs. And so when you put yourself in a situation where you draw down your inventories, and if you go back and look at that period of time, you had lower, you had higher supplier inventories, much higher producer inventories back then, and lower utility inventories. But when you did the total commercial, when you add both of those together, they're lower today than they were then. So people will cherry pick and say, oh, utility inventory then versus now, but you have to look at both. You have to look at what was supplier inventory today is basically very, very little. So, but when you look at what happened when prices started to tick up, now what was it then? Back then in 04, 05, it was a host of things. It was a flood, it was a fire, it was a technical outage at a mine, and that's what Tim was referencing earlier. It was a failed delivery of uranium. One little thing led to another. Inventories were down low. The market was tightening. But yet you had all this under contracting in 01, 02, 03. If you read what was being said back then, so if you went back and did the research and said, okay, what was the prevailing sentiment at the time? Okay, the UXC winter survey, and this is not disparaging of UXC, it's their survey of market participants. What was it? Quote, buyers don't believe there's a problem. They delay contracting. They're failing to send the needed signals to producers. For their part, producers have been burnt so many times in the past, they're not about to invest more in a mere promise of an improving market. Consequently, nothing gets done. Winter survey 2003, price of uranium is about, $14 on its way to 137 in the next few years. Irrational expectations. The reaction to talk of any impending supply shortfalls that we've heard this warning a number of times before, and nothing has happened. So of course, why would it happen now, right? UXC Winter Survey, February 2003, right before the dawn of this. And what was the ingredients? Low inventory levels, underinvestment by suppliers, exactly what you have right now. The difference is it's a much better, you've got a better demand story now, and no new mine supply coming online. So with fuel buyers, so what are we talking about in this market? What you're talking about is, Andrew, when we started looking at this market 5 years ago, if we wanted to go into the spot market in any given month, we could have probably found 15 million pounds. If fast forward to today, if we wanted to go in the spot market and wanted to find more than 1 million free floating pounds, we're going to drive the price up a lot, right? So it's worked down very meaningfully. So you're at the point in this cycle where it's psychological, it's recency bias driven, traders know they can't go secure many pounds at all. So the market's sitting there saying, okay, well, when are the fuel buyers going to come in and start buying? Well, they're out there. They're having these discussions now, several conversations which are bilateral off-market discussions, and it goes back and forth. You're not going to see where contracts are signed. When exactly what's being signed for. The utilities still want lower prices. They're not going to get lower prices. Nobody's giving them lower prices, and so you're at this stage where it's a tug of war. They're dealing with COVID issues. Producers are not blinking. They're not saying, okay, we'll give you lower prices, and it's just part of the cat and mouse, the negotiations. But the bottom line is this: if utilities don't start contracting like yesterday, they're hosed. They're going to be paying prices significantly higher than they need to be paying, and which probably happens. But whether or not is it 3 months, 6 months, who knows? The reality is, though, supply is low, demand has improved, no new mines are coming. And there's such a disconnect between supply and demand structurally. And oh, by the way, getting back to under contracting, since 2013, they've on average contracted 35% of supply, just like last time. And they're sitting there with enormous uncovered needs over the next several years. Long-winded version of saying, I see Twitter. I don't really talk on it anymore. People day to day are wondering. There's nothing to wonder day to day. Do the math. The math is the math. The noise you hear, the noise people hear, just go and understand the historical context of where all of this is, and put it in context of where today is, and stop trying to guess every day of spot price moved a nickel today, a quarter. Who gives a shit? It doesn't matter. The horse has left the barn. There's not enough supply. Utilities are going to get run over. They played this market beautifully for many years. They stayed out of the market while prices were declining. They overplayed their hand. If they come back today, tomorrow, 6 months from now, you're going to see in price discovery, that's their problem. And that's just kind of where it is right now.
Yeah, and it is the prettiest girl in the room, and it's a beautiful setup. But yeah, really, just like you said, you summarized it well. It's something like you really have a choice. Just in time thinking or just in case thinking. So choose wisely and really tell your story buying.
Yeah, and you can find several. You can go talk to fuel buyers now, and some will say, you know what? Yeah, I know we got to pay $50, 55. We'll get there. Others are out there quietly trying to sign contracts for not quite that, but better prices than you see on the surface. And then there are other guys out there going, yep, there's so much inventory out there. Yep, there's so much supply. Look at the prices. We're not doing that. Same guys who are out there begging for pounds at 90 last time and 80 last time. It's just human nature. And you see it. And by the way, and I'll say this, and Tim will jump in. We talk to them. We know supply demand better than we know, the back of our hands. That this is what we do and have for 5 years. And when we talk to these market participants, whether traders or whether fuel buyers, and you want to dive down deep with them on supply and demand, there's nothing greater than a conviction driver than doing that with them. Because we could think of two people in all of our travels that do that on both either the trading side or the utility side, that will really sit down and have a discussion with you about real fundamental supply demand. It doesn't exist. It's all driven by sentiment, and there can be no better setup than that. So anyway, what were you saying?
Yeah,
Tim?
but the only thing I can add to that is that, whenever typically internally when we're talking about utilities and what they're doing, they call it the 80-20 rule, right? Where 20% does 80% of the work. We call it the 90-10 rule, right? There's about 10% of the market we think that is really out there doing the things that they should be doing right now, which is quietly taking care of their fuel cycle needs from SWU up to conversion, up to the feedstock U3O8, which we can talk about a little bit because I think it's under discussed. So these nimbler, smaller, utilities that are at the tip of the spear, if you will, in their industry are playing it smart. But that's a very small percentage of them, and they tend to be smaller utilities that are much more nimble. They're not these behemoths out there per se, and so they're playing it smart. The rest, they're kind of biding their time. They're trying to figure out what to do. They're trying to make sure that their plants are running. But like Mike said, it's a little bit too late. The page should have turned in 2019, 2020, and I know 2020 was a very difficult year because of COVID. We all understand that. But at a certain point, you got to play some catch up. And again, whether it's tomorrow or a year from now, I really don't care.
Yeah.
Yeah, and look, they're still having their safety meeting in the morning and still talking about COVID.
These fuel buyers are the fuel buyers played it beautifully, staying out of the market. There was way too much supply. It was tremendously oversupplied. When their first round of contracts were expiring post paying up in the 07, 8, 9 range, they stayed out of the market. They were very smart. And then, but just like anything, when you do something so long, you become kind of complacent and you believe it's always going to be there. And it was one of the first things that Tim and I noticed early on in our work was that there was no recognition that things could change. And what we always heard was, yeah, we've heard this before. We've heard this before. And so here you are in like 2015 and 16 and 17 saying, oh, we always hear there's not going to be enough supply, but here we are. Well, I'm sorry. Just a decade ago, you were paying twice of what you needed to pay, twice of what the market needed to be balanced because you freaked and you panicked. And it's as though those memories just faded and didn't exist. And then one of the things we always do in any industry, we just wrote about this at length in our letter to our investors, was being a student of the cycles and understanding the history of the industry cycle that you're looking at. There's no greater educator than that. And armed with that, and armed with the behavior of the cohort of buyers and producers, but armed with that, and then seeing how it squares with the mathematical realities, and then what you're hearing. And that's where in this, and you see, oh my God, the recency bias is staggering. It's just what was will be, and what just recently was will be. And then when you push back on it, it's not supported by a fundamental argument. And so the fuel buyers are incredibly bright people, obviously, being nuclear engineers. They are under a lot of pressure depending on regionally where they are. Do their costs get reimbursed? Some of the fuel buyers are dealing with plants that are not competitive to natural gas, and they have real issues, right? And everyone is looking to save a nickel and save a dime. But at some point, you overplay the hand, right? You got to look around the table. You got to know when to fold them, and when to walk to, and done that. And so it's just you can't outrun the math. Now, what they can do and have done is say, okay, well, we're just not going to go and in mass load up on contracts. Okay, well, you've got a lot. They've got a lot to deal with. These people are dealing with tremendous burden during COVID, but that just exacerbates their problem. It doesn't solve it. Because at the end of the day, when we speak to them, we know, oh, well, this mine's coming online, that mine's coming online. Andrew, the world of junior mining is so full of shit, right? So many of these CEOs spend most of their time figuring out how to put lipstick on a pig. And there is no standardized all-in sustaining cost in uranium. And when you look across these projects and you look across the universe of what's real and what's not, and the time frames, it's laughable. But what happens is the fuel buyers look at that too, and they're like, well, this one's coming on. And you're like, dude, you can't be serious. You think that XYZ project is going to be really? And so, but they get there, and it takes one or two, and then all of a sudden it's a stampede. And that's kind of, it doesn't need to be that way, right? When we talk to, like I said, there's one trader that we have immense respect for. We have respect for all of them as people, but from a business standpoint, there's one trading outfit, I should say, that does a really good job of understanding supply and demand. The other guys, I mean, they'll say to you, well, we really are just worried about what's there today, tomorrow, and the next week. There's no balance sheet. They can't take a long-term view. So without that price speculation in the market, with the fuel buyers just trying to figure out how to get through tomorrow, and some of them being cocky, we see it. And we also know who they're referencing for their supply demand work, which we think is laughable, as we've laid out before publicly. So it is what it is. It will get there, and that horse has left the barn.
Yeah, certainly. And the arithmetic is good. There's no doubt about that. It's phenomenal, in fact. And the other thing I would just add too is your guys' wives, like mine, have to be very forgiving individuals, because we live, eat, and breathe, uranium. And so good on them. And I'm glad you guys picked the right ones for this type of setup.
Yeah,
But
yeah. My wife does not want to hear about uranium anymore. She does not care. So we've talked about it for too much.
well, she's sticking in there. I think she sees the reward. So, certainly, and I would just say too, to the utilities, looking at slide decks of these junior mining companies or hopeful mining companies, that's not the right place to look. And then the other part too is, what happens when you go through the McDonald's drive-through and the spicy chicken nuggets aren't available? I mean, it doesn't work.
Well, I mean, it is, and the utilities know some of these projects are bullshit, but they're going to use it, right? They're going to use it in the negotiation process. And well, look at what's coming on. But these are bright people, right? And again, if you have to sit down and compare, that's why the world of like junior mining is dangerous, man. Right? Don't ever forget what Mark Twain said, right? A mine is a hole in the ground with a liar standing next to it. Not everyone, but you got to be careful. A number of them are, and the promotion is crazy. And especially as prices start turning, Tim and I have just, but Tim shut Twitter totally. I've just stopped talking on it because I'm not, who am I? I don't know what somebody's interests are in terms of, macro wise, uranium wise, we have a view, but people just don't, they come at you all day and night with, what do you think of this name or that company or this company? You get DMs. I'm not going to comment on that, right? I just have no interest in that. So I don't even check. I check it once every couple of weeks because that's not my thing to tell people what they should or should not invest in. But my God, just do the work on some of these things. And now you're starting to see people come out of the woodwork. This guy's an expert. That guy's an expert. They know the industry. Really, nobody knows who they are. Like what fuel buyers talk to them, certain things. So you just got to be careful. It's very tricky.
We've said it before, we've said it before that you've got to do your own due diligence. And that goes beyond listening to interviews, including this one. We've right. said it in the past. You've got to do primary research. Companies offer quarterlies. In Richards, Urenco puts out a half annual and an annual report. Go and read as much primary being the key word, not a news article, a primary research place, and just go read a 10K. Just go read something for a day. You're going to learn something, I guarantee it, and it's going to generate a lot of questions. When we started in this, every question we answered led us to 10 more questions. And you just would have to start working through it. And particularly in the mining space, you do have to be careful. This is why we tell people, make sure you're doing due diligence. Make sure you understand management and the asset and, the geology around it, the mining engineering around it. You've got to spend time doing that. So it's up to people, if you're going to invest your money, that you are your own portfolio manager. You're the one who is going to have conversations with yourself in the mirror about why you're buying or selling. And don't rely on anybody else but yourself to make those decisions. You can ask people, but at the end of the day, you're the one who has to pull the trigger on these things.
Yeah, that's absolutely right. You're full responsible for your actions here, and it makes complete sense to me. And meanwhile, Mike's closed Twitter account or silent Twitter account continues to gain followers, even with Mike not saying any words, which is great.
Well, it's funny. And also what I realize is, like, I won't name a couple of people, but saying, oh, he's not talking for what? Okay, well. So you want me to? I'm not a promoter. I don't know what to say. We've laid out our supply demand case on I don't know how many decks we have out there, which is pretty detailed decks that I don't think I see from anyone else that are out there with how we arrived at what it is. And then after that, there's not a lot to say. It's just constantly doing the work. Right. And that's it. And once in a while, I'm happy to do these, but it's not that I don't want to. There's nothing to say, right? It's supply, it's demand, it's an inelastic market. There are buckets of things that you look at, right? Why nuclear? What's going on the demand side, country by country? Where are we in the contracting? What's uncovered demand happening? Where are we on the cost curve? Okay, you lay it out there, and then your greatest ally is time. And patience, And I chuckle when we started looking. I forget where the price 15 or 16 in 2015 or 16. It was $17 a pound or $18 a pound. I think when we launched Sachem, it was $22, and here we are. I'm referencing spot just because it's easy. That's what people recognize. Now it's what, $30. And how we look at it is, what's the risk reward? Is the price going to go up or down? Well, it keeps going up, and it just keeps getting to where it needs to get to. And then what will happen is, boom, all of a sudden it's going to hit a wall. That's the wrong term. It's going to just be like an accelerant, where it's moving, it's climbing, it's slowly climbing. The buyers are starting to still, I'll give you an example. We spoke to a trader, and I won't mention the name, 2 weeks ago, Tim, I guess it was.
Yeah, thereabouts.
Yeah, and this trader, who we spoke to for quite some time, would over the 4 or 5 years, would say, "Oh yeah, there's more uranium out there than you could shake a stick at. Yep. Oh yeah, mountains of it. Yep." And now we knew, after speaking to said trader once, the first time, that this guy has no idea what supply or demand is. Can't see past tomorrow, but been around doing this and all that, but not his job, because there's no balance sheet to express the view long term. It's just, let's move pounds from point A to point B. Let's sell back and forth to each other, and that's what they do. That's fine. They're salespeople. They're not traders, as you know it, but that's what they do. But it became very clear, and what you realize is, when you come into this market as an quote outsider, as they look at us as outsiders, they look at us and say, okay, well, they're out. They don't know what, right? I'm sorry, what, you need to be a nuclear engineer to do 4th grade math? Nope. Don't, because I couldn't be a nuclear engineer or a geologist, but you don't need to be a nuclear engineer to do math, addition, subtraction, multiplication, and division. But anyway, in talking to this guy over the years, and you establish a benchmark, right? Oh yeah, all you could see. And then, we played stupid 4 years ago or so. You start talking to people, and they don't know that you're armed with all the math, and you just start letting them talk. And then a second or third meeting, phone call, in-person meeting, you start peeling the onion back a little bit, letting them know that you might know a little bit more than they think you know. And then you just really start to bring it on. And then, like in our case, we go out and speak publicly. You put decks out there and you say, here's why you're fucking wrong. Oh, excuse my French. So eventually they know that you kind of know what you're talking about. But the point is, we were speaking to one of these traders who there was more uranium than he ever can do, to where the conversation 2 weeks ago was, spot's very thin, which was, Tim and I laughed. We were texting each other, laughing, saying, okay. And then it was followed by, well, what do you think of the uranium reserve? If they, you are energy and energy fuels, they could produce an extra 1 million pounds. Maybe. Could they? And then what about that Brazilian phosphate plant, and that's going to come online in 3 or 4 years for a couple of 1 million pounds? Seriously, right? And I said, like, you're kidding, right? This is the best you got? This went from being a mountain of oversupply to now you're worried about the U.S., whether or not these guys produce 1 million pounds in a market that's got a 35+ million pound deficit, right? So that's the realization that you start to see, but you don't see that unless you have a baseline, you talk to people, and then you realize, whether it's this person or whether it's the fuel buyer you've spoken to, all of a sudden the epiphany comes. Whether back in the prior cycle, it was a fire, it was a flood, it was a missed shipment because of a transportation problem, it was a technical issue at a mine. Today, it's COVID, right? That's the eye opener for them. And here we are. But at the end of the day, for us, it's risk reward. What causes the price of uranium to go down versus what requires it to go up? And we'll take that trade all day long.
Yeah. And I like your impersonation. I like that. Keep that up.
Dude, you get so exhausted from talking to some of these people. Very, again, nice people, but when you're talking to them, you just want to bang your head against the wall sometimes.
Yeah.
So because what you realize when you do these deeply cyclical industries, what you realize is people have such strong opinions with so little work behind it. And it's only because they draw on their most recent experiences. And that as an investor, taking the other side of that is truly a gift. Not you're gifted to do it, but they're giving you a gift. Yeah,
definitely really encourage the audience to go after CDAR, go after, CD, look at the NI 43101 documents, spend some time. It's going to take thousands of hours and tens of thousands of pages. ASX filings, they go way back, lots of stuff out there. And, the other thing too, is I think the audience needs to understand is, look, you guys aren't going to share information on an interview, just like, nor will I, all information. And there's stuff that's just private. So that's just how it goes.
Yeah. I mean, and some people said, he works for his investors. Oh, sorry. I mean, if there's certain things that are proprietary. I've
said this in the past as well on another program. And, to encourage people to use some of these programs and podcasts and interviews as jump off points. Bring your pen and paper. When someone says something that maybe perks your interest or something that you may not have realized, make a note of it so you can go back and say, let me go read Urenco stuff. Let me go check out if 10X has anything online. It's that type of intellectual curiosity that will help give you at least something beyond just the chitter chatter of, news articles and things like that.
Yes, go look up some stuff. Go look at phosphate. Go look at these other areas that are not so discussed, etc. Mike, you brought it up. You sparked my interest on this. Is when you come hungry and motivated, like an investor, like you guys, into this sector, isn't it just obvious that you guys would be much more motivated to understand something rather than someone that sits here that's been in the industry for decades, that sells a subscription, has no vested interest? Wouldn't that just be obvious that you guys would learn much faster?
You would. Well, and also, Andrew, when you think about it, we have our capital at risk, right? So nobody, if you were sitting on the other side of the trade, now I can't tell you the resistance that we get when Tim and I go to an industry conference. Now, pre-COVID, we were at all of them, and we were asked by these governing bodies who have seen our analysis. One of the nuclear institutes hey, we have a different view of consensus. There's consensus out there, and let us show you why we think it's BS. Wrong, right? Not saying that untoward, but wrong, and steeped with inconsistencies and things that just don't make sense, and things that were changed post facto, and we presented to a room full of 200 people that buy uranium, and said, hey, here you go. By the way, I know you think we're just kind of some guys, just Wall Street bad guys, which is what people think, right? But no, we've been here in the sector now for years, and we have a lot of capital at risk. And therefore, we've done the work. And this organization thinks, and we've showed them what we've done, and they've given us the bully pulpit to come here and talk. And you can believe us or not. And we lay out a story, and you lay it out for them. And what do you hear? These guys think they know more than we do. No. We're showing you that there's inconsistency in the work that you have and that you're getting that's helping you inform your decisions. And it's ticked and tied, right? None of this is ours. We've spent 20,000 hours, I don't make that up, analyzing certain consensus numbers. And here's why they don't make sense. And if you don't open your mind to that, when you get run over, good for you, because you deserve it, right? Now, there are some that are open-minded and will say, okay, that's great. Thank you. Can we pick your brain? We get inbound phone calls. But way more than not, can Tim and I walk around one of these conferences after having done that, and people will put their head down when they walk by us. Now, every once in a while, you get a guy that comes up to us, and he'll probably be mad for me saying, well, I won't say his name, but he's a fuel buyer, and I do know he's active on Twitter. And he tracked down Tim and me and Art and Adam at Segra at some country bar and said, "Hey, could I talk to you guys? I'd love to pick your brain and I'd love to share with you my thoughts." And you know what? When you read his stuff, he's so smart and he's so ahead of the curve and he gets it. But that's not most of them. Most of them are really smart. Well, shit ton smarter than me, and probably Tim, but maybe not. But
Yes.
but yeah. But the point is, Andrew, they're not curious. And why? This if in all my years of investing, this has been by far the biggest eye opener I've ever seen. I was always kind of drilled, what's the power of incentives? And you hear like, yeah, what's the guy's pay structure? The CEO, does he get options? What is it? Is it driven by cash flow or is it driven by revenue? How much of it is driven by stock price? Whatever it might be. This takes it to such an order of magnitude different is what are the financial incentives of the people in the marketplace, right? The guy buying the uranium, he does not get one extra penny if he bottom ticked it. It just doesn't happen, right? We know of a fuel buyer who saved his utility a ton. And fortunately for that utility, this is a very bright, thoughtful person who wanted to save the ratepayers money. And he went out and made some really smart purchases, but doesn't really participate in the financial upside of that. And he's unique. What that leads to, they don't get penalized they don't get rewarded for doing that work that saves a fortune, but they get penalized if they have to go. They don't get penalized if they have to pay up, as long as the peers are doing it. And you're like, wow, that's something I can't even remember seeing. And then as you start working within this cycle and start talking to people, again, nice people, smart people, just different incentives. And when you take different incentives that don't motivate to actually figure out what the real numbers are, because it's okay to go along to be along, and you marry that up with kind of an attitude is, you know what, I'm a pretty smart guy. I've got a really fancy degree, and what could these people possibly know? What could they tell me? And even worse, even better, I'm not going to ask them. Yeah, I get that. I get that they put up all these numbers, but they're just Wall Street guys. What do they know? They're not. They're outsiders, right?
Yeah.
Again, we're not building a nuclear power plant. We're looking at supply and demand, and we're sitting there and spending 20,000 plus hours analyzing what those numbers were back at the last time this happened, and that's all it is. Like none of this is complicated. It's just time consuming.
Yeah, country bars and non-cash flowing companies sitting in their chairs and collecting the triple P program in the States. Okay, let's move on here. I want to get back to the screen and pick it up here just a little bit because I know you guys' time's valuable. Hopefully we can get some more out of you here as we keep going. But Tim, spot market depth as indicated in 2020. Chemical buys a few pounds, price rises on some light volume. Thoughts on trying to buy big volumes while walking around in a waiting pool?
I think it's going to be tough today. Look, the market is just illiquid right now. It's a little tough to purchase stuff. It's tough to sell stuff due to some of the not a lot of RFPs into the market right now. It's the very beginning of the year. We typically see some of the activity increase on the U308 side. Maybe we get a little bit of a pickup in RFPs where the utilities go out and request for proposals. Maybe end of Q1, maybe beginning of Q2. Who knows? I don't know. I don't have a crystal ball on that. But typically they begin to pick up a little bit more activity. And because of that, people need to understand that, there's a lot of people throw things around about, what is a carry trade? How does that work? Well, if traders are winning carry trades, they do tend to generate spot activity. I mean, some have offtake agreements where they can fulfill RFPs if they win them, whereas others, or even if some do have an off-market agreement to take pounds in every month, they might have to go into the spot market to secure pounds for that carry trade. So carry trades really just try to help link up this mismatch in supply and demand. Basically, a utility saying, hey, I need some supply. I don't want to buy it and take it into my account today. I want to do it, maybe 6, 12, 18, 24 months from now. And traders do facilitate that transaction. So it does tend to generate some spot demand. So because there's been a lack of RFPs, they haven't needed to come into the spot market and do stuff. So, yes, the market's a touchy liquid today. I don't expect this to exist forever as kind of the market transactions pick up here. But time will tell how that goes. The other part of that conversation, I think, is what's going on in the fuel cycle. I think one of the big misnomers and one of the big mistakes people make in this sector is being so focused on quote unquote uranium, U3O8, without really understanding what is conversion, what is enrichment, and what does that fuel cycle look like? Because when we look, when we go from U3O8, it's got to be converted into something called UF6, and then that UF6 has to be enriched. Well, there's ricochet effects up and down the fuel cycle based on the dynamics in these markets. And so if you're a utility, you're always going to look at your EUP first, because at the end of the day, you just care about the enriched product, and you're going to work your way up the fuel cycle from EUP to UF6, which is the conversion component, and then back to U3O8. And due to the oversupply, it was oversupplied across the fuel cycle. It wasn't just U3O8. It was because the Japanese went offline in 2011. And as their contracts rolled off, they weren't buying a lot of conversion. They weren't buying, doing a lot of new SWU contracts. So it created overcapacities all along the fuel cycle. So all of that excess supply needed to be worked down. And we're there. We're already past peak underfeeding, so there's less EUP out there. There's way less UF6 out there. In fact, if you're a utility and need to go buy some UF6 today, you're going to have to go to a producer. You're going to have to go to a converter to get that stuff. I don't really think there's any being held, certainly in big pounds in any way, shape, or form by intermediaries, by financials today. And so why am I saying all this? What I'm saying is utilities are going to go sop up excess supply further down the fuel cycle first. And they've been doing that for 1, 2, 3, 4 years. We've seen conversion prices re-rate from $4.50 a KGU to, it's $20, $21, $22 today because these bottlenecks in conversion continue to exist. So there's less, all that excess UF6 has been sucked down. And so finally, we're to this point where we can move into and finally get into really the bones of it, which is the U3O8 market, because all this stuff further down the fuel cycle has been sucked down. And that's kind of where we are today. So yes, we do think activity will pick up in the U3O8 market. It has to. Well, maybe it doesn't have to per se, but we think it's definitely going to, because at the end of the day, conversion and enrichment are just services. And that's what's important for people to understand. But you ultimately need to get the feedstock U3O8. And we're kind of at the final stop where we suck down the EUP, underfeeding, we're well past peak underfeeding at the enricher stage. The converters are Converdyne's still down. The French are, there's a temporary shutdown at their Malvézy plant today. So that's the first stage of the French conversion, and then it goes to their main plant, which is continuing to ramp up and slowly ramp up. They've had some issues there. So we're kind of to that final stage where, okay, now we've got to start paying attention to the U3O8 market in a much more concentrated way, because we can't buy U3O8 in a UF6 form very easily anymore. We can't just go out and get EUP willy-nilly. So we do think over the next 6, 12, 24 months, there'll be a lot more attention paid to the U3O8 market, because any other form has been sucked down in a major way.
And Tim, as SWU prices rise, what happens to the incentive to underfeed?
Well, I think we already know. At the end of the day, enrichers don't, their main business model is not to underfeed. That was born out of necessity due to Fukushima, where within the specific lens of an enricher's world, they're not going to get rid of centrifuges because they've already made huge fixed capital expenditures to get them up and running. So they're just going to underfeed if that capacity is there. But we know that they're signing new contracts. They're getting back to their primary business model, which is to fulfill SWU contracts, separative work units, and that leads to less underfeeding, which leads to less EUP on the market. And if they're re-enriching tails, that leads to less U3O8 on the market. So we believe we are well past this peak underfeeding phase. It's being reduced. It's continuing to be reduced. This will continue to happen. And We know this because SWU prices are rising. And let's just, let me just say this as well. On the services side, the suppliers have a better ability to control the market pricing a little bit just because the supply base is a lot more concentrated. There's only a handful of enrichers in the world. There's only a handful of converters in the world relative to U3O8 suppliers, where it's just a little bit more of a fragmented market. So they do have an ability to kind of swing the market around in their favor, and they're doing that. We've seen SWU prices trough at $34 a KGU, and I think spot's $52 today. Long-term prices have moved up from the mid-low 30s to $56 or so today, thereabouts. That are the published prices. Conversion has moved from $4.50 to $20 to $22 depending on location. So we know that these transitions are happening. And just to link it back to the earlier stuff Mike was talking about, when people aren't paying attention to the details, when people aren't digging into the guts of this market and just looking at, staring at the spot price of U3O8, you are going to pick up none of this. So there's a lot of stuff happening under the water that you're not seeing at the surface.
Yeah, Tim, and well said. And I want to bring this back to you for a moment. An assumption here. Let's just say the SWU prices are at $100 plus sometime in the future. Does that happen, number one? And if it happens at that time, what does the market for equities and the uranium price look like here?
It's, I guess, a multi-million-dollar question, right? Look, I don't know where the SWU price goes, at, whether it goes back to, $90 or $100. I think if you're getting into the mid-60s, mid-70s, that's at least a much more sustainable price for enrichers. Does it mean that it overshoots? Maybe, maybe not. I don't know if I can really say it's going to go to 100 or not go to 100. I think we do need to grind to a little bit more of a sustainable place, and it'll be a slowly rising market in the SWU market. And interestingly, we're learning more now that as prices of these separative work units rise, utilities are more and more incented to go and secure more because they do see that it's rising and that maybe supplies and capacities are a bit tighter than they realize. But I can tell you, if SWU is going to, theoretically, let's say SWU goes to $100 a KGU. I mean, that's going to mean that they're going to need to be buying a lot of U3O8 to fulfill those future SWU contracts. You're not going to buy services if you're a utility and then not ultimately buy the feedstock. And where the equities go, who knows? They would obviously be higher. How much higher, is anybody's guess.
I think Mike left us for a moment, and I think he's back now. But look, is there any clear estimate? And I'm not asking you guys to provide exact numbers or any proprietary information, but where do you guys see mobile inventory here at this point? Maybe a ballpark. And to complete the audience question, and again, I think we've answered it in another way here, but why isn't long-term or spot moving yet with all the expected new demand and of course the supply side destruction?
Well, I think that they're active in securing SWU contracts. They're active in sorting out this bottleneck in the conversion market. I mean, you still don't have Metropolis running Converdine. That plant in Springfield or in Springfield, Illinois, I think, right? Not Springfield, wherever it is in Illinois, is Metropolis, Illinois. My apologies. It is still down. Utilities are worried about this. That Converdine is still down. Is it going to come back? Do they have enough contracts in hand, long-term contracts signed in hand to bring this plant back? There's some issues in the French facilities that are continuing to, a temporary shutdown now at one of them, and the other one's continuing to be ramped up. That's a big bottleneck. They've got to make sure, hey, if I'm going to buy U3O8, can I get it converted? Well, how long is that going to take? When can I get it? Is there available UF6 stocks that I can buy above ground now? Where is that? So they're looking at each step of the supply chain, and quite frankly, the conversion bottleneck is a problem right now. I mean, we see what prices have done. They've ticked back up. I mean, I'm surprised that they ticked back up, quite frankly. I thought that, hey, they would hang out at $18, $20, but because of the continued shutdown in Illinois, some of the kind of continuing problems with the French facilities, that's been a main focus of theirs. So again, U3O8 is the last place that they're going to go because you can find U3O8 in other forms, and they're just trying to work through those issues, I think, to some extent, while being cognizant of their feedstock U3O8 needs in the future.
Right. Certainly to the audience question, there's discussions behind the scenes, definitely, but there's nothing happening on the spot or the long-term market as far as uranium goes.
The question should be asked the other way. It comes down to, do they have enough supply to handle what they need in the future? Nothing's happening, right? Because, okay, you're sitting there and you're reading headlines and not actually, somebody's not diving in and doing the work. So of course, nothing's happening. Tim just laid out what's happening underneath the surface, but also ask yourself the question, if there was excess inventory out there and there's nothing happening and utilities aren't in there stepping up in the spot market buying, how come people aren't shitting the bed and spitting it out all over the place? If there was excess supply, they would be, and that's not happening, right? So it's, stare at price, focus on fundamentals and not stare at the price. Is what we would say. At least that's what we do. We could be completely wrong, by the way, but that's what we do.
And again, the staring at the price thing in uranium versus other markets, this is, again, another point that makes uranium so unique. Because there is not a real futures market with lots of notional value being traded every day, because there's not a really active physical market with end users, financial traders, financial speculators, day to day, I'm talking, in this market relative to other commodities people are used to looking at, you're just not going to get that day to day, quote unquote, price discovery. You're just not. I mean, this is how this industry, how this ecosystem works. So if you're looking at price to tell you, well, U3O8 price isn't moving, so clearly this is, a really oversupplied market. I mean, that's just a very superficial and, quite frankly, incorrect way to look at it. You've got to understand the nuances of it in the context of who's buying and selling, who's literally there. Do they have risk capital? Do they not? And this goes back to a point that Mike and I talk about a lot, is that people today are too reliant on their screens. They're so used to getting information from prices because of electronic trading and the girth of speculators out there in the futures markets and the stock markets, that they think every market is like that. And it's not. You really need to understand the plumbing of the market, which is why we repeatedly say this, that you have to understand the guts and the underbelly of the market. You have to understand who's literally there, who are the trading houses, who are the end users, who are the people who can come in and do things, and understand how these mechanisms work. Because if you don't, you're going to look at price and not understand what's actually happening.
Such a good point. And Andrew, a market implies functioning. A market implies that it's relatively functioning. The uranium market is a disaster. It is broken. It's dysfunctional. The cohorts that play in it are just, they're not financially incentivized. Everything about the uranium physical market is a train wreck, and that is beautiful to us. I can't explain to you how inefficient it is, how at times you could see come month end how the prices start to drop off because some people have offtake agreements and a couple of traders want to drop the price a little bit, right? Okay, game, you get it. They're playing around a little bit, but stuff happens all the time. But when you're in this and talking every day, Tim and I don't pay any attention to the day-to-day movements of this stuff. It's not important because, are there more, like right now, utilities are really focused on keeping things operating, and we know they're having behind the scenes discussions and they're battling it out with prices, but they haven't been active in the spot market for several months. Okay, well, if you had, like I said just a few minutes ago, if you had a lot of excess supply or any excess supply, the price would be dropping like a rock. And it's not, because why? And why? Because you have to know the traders don't have balance sheets. They right. Think about this. They can't. There's no risk capital in the place.
Right, and people come with a superficial view and they say, if the supply dynamics were so good as you claim them to be, or the SD is so good that you claim them to be, why isn't the market moving? And what the flaw in this thinking is that they're conflating the day-to-day supply that comes to the market with the day-to-day demand that comes to the market versus the structural fuel consumption versus supply and like a more macro view. So if sometimes I'll see people say, well, the spot market went down 25 cents today, but aren't we in a huge deficit? Like this isn't working. This thesis is obviously not working. And those are two completely separate concepts, because day to day, the structural supply and demand of this market is not going to be reflected in the spot price. It's good because, again, the intermediaries have to have a view every day. Oh, we're getting some offtake. Should we sell today? Should we not?
Yes.
Should we sell it next week? Is the market going to be 25 cents higher next week? That's what they're thinking about day to day.
And there are always, Andrew, always some of those pounds in the market. When the market was at $137, there was 20, 30 million pounds in the spot market. One would think, well, how could that be? There's no pounds available. Because some producers are lower cost. Some producers don't give a crap about profits. They have a little bit left over and they're going to put it into the spot market, right? So as the market's transitioning from one where it's traditionally has always been, because there's no substitute for the commodity, it's been a market driven by production economics. Right. And then when Fukushima happens in periods of excess supply, it's simply a market for surplus disposal. And then eventually, the curve has to move back to driven by production economics. And that's driven by where inventory levels are. And when you look around and you do the math, you ask about mobile inventories, they're a little below normal, right? It's just now, right? So and then you don't have these secondary supplies, the underfeeding is slowed down. There's a confluence of events where you're saying, okay, but as that market's transitioning and there's still a few pounds in there, that recency bias from that utility buyer who says, normally, all right, I know my contracts are up, but I had all this carry trade stuff out there, so I'm going to go in and just top up again for a year. And so, well, what might have been out there at 15 million pounds a month, 10 million pounds a month, 5 million pounds a month, that gets harder and harder to find. And then it's one thing. You never know what that one thing is that triggers somebody to panic. And then next thing you know, boom, it's up. Or on the back end, somebody's signing a long-term contract and you're not going to know about it until you see somebody's quarterly report. So all these things could happen. But it's being positioned because of supply and demand. That's how we look at it. Again, we could be totally wrong, but that's our view of the world.
Yeah. This sector specifically is conventional rotary dial. I mean, pick up the telephone. That's where you're going to get your most info. And really it's rinse and repeat. When you talk about the cycle, talk about the oversupply, back Fukushima, et cetera, it's rinse and repeat here. And it's going to happen again, of course, in a similar rhythm and fashion. And then the other thing too, Mike, just real quick on wrapping up here on the screen, and then also just on mobile inventory, would you like to give a ballpark figure on what you guys see as mobile inventory at this point?
No, we can do no.
Okay.
No, we say a couple of years, right? A couple of years U.S. No, because then you know why? Because Bob in Topeka somewhere is going to sit there and it's going to lead up to 87 direct messages that say, oh, is it this million or that million? A few million? I thought you said that yesterday. Come on, like we've given enough out there. It's our view. Go look at the decks of what our view is of inventory. It's a couple years here around in the U.S. It's 3 years there, right? And on the margin, it's at or below, depending on what utility it is, versus when you had a lot of supply, you had 5 years of supply, 4.5, 5. So that's the thing, right?
Here's a little quick amusing story about, this must have been a solid year ago, maybe almost a year and a half ago. In a kind of,
by the way, nothing against Topeka. I like Topeka, so I didn't know anything about it.
And as it kind of bleeds into the trade action discussions is, over a year ago, I remember half joking / half serious with Mike saying, the 232 working group is going to bleed into the Russian suspension agreement. And I guarantee you people are going to be complaining out there that, once again, the utilities had an excuse not to do anything. And this was a year before the Russian suspension agreement happened, because the writing was on the wall that some of these trade action things were taking too much time, not too much time, but just it was slowly happening. And some investors were getting very frustrated with that. And we could see that it was going to bleed into the RSA because the utilities needed to understand the U.S. utilities and other utilities wanted to understand what the rules of the road were going to be for U.S. utilities and where and how they could secure U308, conversion, EUP, those sorts of things. So, and I say that because things change. Markets are a living, breathing thing. And we certainly didn't predict, Section 232 in the working group or anything like that. That happened, after we got into the space. So you've got to just deal with the cards that are in front of you and say, okay, here's the cards that I've been dealt. This is what's happening. Where can we go from here? Instead of saying, oh, well, the utilities are just doing absolutely nothing. I mean, they're not doing nothing. They're doing a lot of things. They're running their plants. They're focused on various parts of the fuel cycle. So it's just a reminder that things do change in markets, shockingly enough, and things do change in the uranium market. That could be hiccups. They could speed things up. They could slow things down. And you just have to recognize where all that fits into the, your view and thesis and market view.
Yeah, it's tough to translate because a lot of the stuff you don't ever see come across any conventional channels, if you will. You have to dig a little deeper to see where that goes and all the debits and credits that go with that. But you guys mentioned it earlier. So much is important with regards to the work and writing checks and having capital at risk is so important to, in my view, motivating the proper research and investigation.
No question.
Real quick, Tim, finish for us on the trade actions. I suspect that there's probably no more trade actions to go here. And then also maybe just speak briefly about the bank research possibly increasing here.
Yeah, sure. I mean, we certainly never predicted Section 232 and all of that. So knock on wood, literally here, I'm going to, maybe something does pop up. I mean, I don't see anything on the horizon, but you just don't know, and so you have to be cognizant of that. But nothing majorly specific that I can foresee. But again, I never predicted Section 2. I didn't even know what a Petition 232 was until I read about it in January of 2018. Now I'm very familiar with it. But so yeah, those are the main ones for sure that were absolutely out there. We're certainly behind those now, or those items are behind us, and it appears we have a lot of road ahead. And I guess that leads into the bank research. There's been a lot more interest coming back to the space. When a commodity sector is in a major bear market, there's not a lot of banking business to be done. There's not a lot of mergers and acquisitions happening. Banks are going to kind of lose interest, right? That they have their own incentives too. Now they're seeing that, okay, we're in supply deficits here. Producers are telling us that we need to have higher incentive prices to bring this market back in balance. They're figuring the story out just like we did. It takes time, it takes energy, it takes effort. It takes speaking to people for months and months on end to get your head around it. They're clearly beginning to, and their supply demand forecasts are doing exactly what we expected them to do, which is show larger and more sustained supply deficits as we arrived to a few years ago. So I think it's bringing just more professionals to the space, more eyeballs to the space. They're letting their clients know, hey, there's some smoke here. There could be some fire here soon. So let's take a look at this. Is this a potential allocation for you, given your view of the dollar, of commodities, of where other equity and asset classes are relative to this? Because just like we think, this idea of uranium and investing in uranium is kind of alpha in a bottle. So if you're a fund of any kind, you can allocate small amounts of capital to this space. That's a very small portion of your fund that can create real alpha for you.
Yeah, no, certainly it can move the needle significantly, even if it's small. Mike, talk about the current Chinese view, or Tim, and their continued effort to absorb global capacity, most recently with Kazatomprom, the Ortalic joint venture.
Yeah, well, so the Chinese are obviously they're a major driver of nuclear power. I think you've got the 14th five-year plan that will be more formalized coming in March, but there's no surprise that their goals are they want to be carbon neutral by 2060, and you're not going to get there unless you're building a lot of nuclear reactors. You're just not going to get there any other way. It's got to be part of the conversation. So what do they not have indigenously? They don't have much uranium production. They have a little, but not a lot. So they have to go and either buy outright mines, and Namibia has been a stopping point for them, or they make investments in them. They've done that in Canada, and now they're doing it in Kazakhstan. But people will look at their uranium levels and take a very Western view they might have 400 million, and maybe they use 45 million. They'll use, not now, but they'll get to 50 million pounds, let's say, or 45, 50, depending on how many reactors they build. We can come up with all different numbers, but one could look at it and say, oh, that there's 9-10 years of inventory versus like 2 to 3 for the West. Well, when you talk to people within China, that compared to other commodities, it's a rounding error in terms of years. They don't think in terms of years, especially in a commodity they don't control. They don't want to be part. They don't want to be held hostage by anyone. So we expect them to be regular purchasers of both the commodity and acquiring assets going forward, because they are not going to let these inventories down. These inventories they're not ever seeing the light of day. They're in government stockpiles. They're sitting down and they're not being used. So yeah, China will be a major player, and it's just the fact. The reality is they recognize that it's enormous. It's baseload nuclear power is a workhorse. It's clean. It's safe. It's here, and it's going to be part of their mix. And as the Hualong 1 is proved to be working now, you're going to see them become more of an exporter of reactors around the world, just like the Russians are.
Yeah, and they're playing the long game, right? They're building reactors that are planning to run for 60, 80 years, right? So if you have a 1 gigawatt reactor and you're going to plan to run it for 60 years, that plant's going to need roughly 30 million pounds of U3O8 over its lifetime. And, it sounds like a big number, but of course it's over, 60 years. If it's an 80-year life, you're talking maybe 40 million pounds. So a 400 million pound stockpile is just not a lot for them. Okay, they are looking out over decades.
When we speak to the people we talk to over there, it's laughable that the West thinks that way. That's not how we think. It's just not the way we're thinking about it.
So. And similarly, another state-owned, Orano, they're looking for, exploring, in Uzbekistan a little bit. They recently announced that they're going to try to do some exploring in Greenland. Look, kudos to the Chinese for playing the long game, and kudos to them for buying assets when they don't have to overpay for them right now. That's called being smart. Okay, relative to many other people in the world who are doing this just-in-time game that always ends in tears.
Or you're going to see a big Western mining company come in at the top of the uranium cycle and pay a stupid price for some of these assets, because that's what they do. Versus the Chinese saying, you know what, let's buy some stuff here cheaply. So
yeah. No, look, and that's absolutely right. I think to some degree that folks in Europe and North America have gotten lazy, fat, and happy. And
yes,
look, we've certainly gotten some reminders here. And if you look at the natural resource sector as a whole, China has a view of decades. Their view is decades forward.
Absolutely.
You can see that with their accumulation of copper, gold, all the base metal stuff, lots and lots of stuff, not just uranium. So it's really fantastic.
And what's funny, Andrew, is Tim and I always say this, and we talk to some friends who do the type of investing we do. It's when people are driven by a recency bias and an opaque, funky, bizarre, broken market like uranium, they will look at it and say, oh, well, there's X number of pounds here. Or they look to all these reasons, but then as soon as for whatever that is, whatever triggers the market to go up, and there's a trigger and it's boom, it's on now. All the participants have decided now you're in a raging bull market. Then they look at that and go, my gosh, oh, geez, the Chinese only have 400 million pounds of uranium, right? It goes from it will go from it being an overhang to it being under. It's the same thing when people are looking at their discounted cash flow analysis or on these projects. What they want to assign massive discount rates now when the market's ripping. They'll cut that in half and say, is that too high? I feel like that's too high because you can, right? So it's right. It's just recency. It's
And
caught up
just
in the
as like kind
world.
of a funny past anecdote, I'll never forget this. It was fall 2004. I believe WTI oil prices took out $40, nominal, and everybody. I was a freshman in college, and I was taking an econ course, and I distinctly remember we were all talking in the class, and everyone's like, "Wow, like oil prices took out $40." And what we all figured out, a year or two later, and all of Wall Street did was that China was buying the crap out of commodities. And so everyone will say, man, if I knew that they were really doing that, man, you could have made so much money in commodities, yada, yada, yada. Well, here's your chance. Here's China on a massive build out of nuclear who's going to need massive amounts of uranium. So if you're looking at that analog back in 2004 to 2008 in the run up to the financial crisis, well, here's your chance to play that just in uranium with China. So, I don't know why you're standing on the sidelines.
Well, yeah, no, and Tim was doing both back then. He was also not only a contributor to class, but he was also planning the parties as well.
That is true. That's actually true.
So I want to move to the discussion part of this, and as we continue through the stuff here, and I appreciate you guys hanging with us here, and there are lots of good conversation points. But Mike, yes or no question here. Is the Sachem Fund open to new high net worth today?
No,
Excellent.
we are closed. We are at our capacity.
Okay. And Tim, is the
Closed meaning,
uranium
by the way, Andrew, not to interrupt, but closed meaning we're not taking on new investors. We are fully invested, but we're at our stated capacity.
understood?
Yeah.
And Tim, is uranium the only focus of the entire Sachem Cove Partners Fund?
Yes.
Mike, if there was a near-term March 2020 type event in the broad markets, which spilled over into say a 50% plus decline in uranium equities, would the fund seek new capital to cash up and deploy on further accumulation?
That's a good question. Consider it. I mean, that would be a gift. So yes, but yeah, probably. But we don't talk about what our strategy is. But if you had a macro event, again, you have to look at everything at the time when it occurs. But our fundamental thesis has never been stronger in our view, and we laid it out for our investors in our letter that we just sent out, and yeah, so we're at our highest conviction, and like we said in the letter, we expect there to be air pockets, and there will be down months, and sentiment shifts, and whatever, and we view those as opportunities.
Yeah, and Mike, the besides Sachem client updates, of course, you guys aren't really engaged in the public as you used to. Like us, you don't really see the need to oversaturate because there is more important work to do that needs to be done behind the scenes. But
we're not that interesting.
And going forward, well, the nice thing, and back to your earlier comment, the nice thing about it is when you have nothing further to say, it really speaks to the fact that, look, we've done the work. There's nothing else to do. Let's sit back and focus on what needs to matter going forward.
Yeah.
I don't feel the need to have to defend a bull argument or a bull thesis in this market. If people who are, neutral or bearish have those views, knock themselves out. They can talk themselves face, until they're blue in the face. That's what they should be doing if they feel that, and that's their views. But I don't feel the need to defend this bull thesis anymore. Enrichment is recovering. Conversion has recovered and still actually rallying right now. And we're not in a bear market in the U308 market anymore. So I don't know what people are looking at.
Right.
If they feel that way, if they're neutral or bearish.
I know you can't divulge certain information here, but what areas of the market will you guys be focused on going forward? What will you be doing to drive market value? And will you be consulting with new entrant capital groups on the thesis?
We don't, it depends. We don't consult with anyone. Just like as I've been in the business for a long time, so you have friends who are investors that are, and they may want to get up to speed, and they'll give me a call and say, "Can you walk us through?" You say, "Sure," and just give you spend time as you would with any other friend. You get them up to speed on the industry. Then there are some who are not that we don't know, we're not friendly with, but they might be other professional investors. And we've seen much more of an influx of that recently. It depends who they are, and it depends how they come across with us. If they come across as dickheads, they got no chance of it, and we've seen that, right? So if they come across as just humble, nice guys, or ladies, and they want to just ask our view and not come at it with arrogance or whatever it might be, we're happy to share that. So it really depends. I mean, we had a call with a big fund last year, I think it was, that came on like gangbusters, like they knew what they were talking about, and it was clear they had no idea what they were talking about. And I think within about 15 minutes, we pretty much told them that. So it's like anything else, right? We don't hold ourselves. I have zero interest in consulting to anyone. We're not consulting to anyone. If people are cordial and they're nice and they want to spend time getting up to speed, we're happy to do that. To spend a little bit of time. If they're institutional investors, I can't do it with everyone that wants to call. But if somebody's got a lot of capital to put to work and they want to learn about it, we're happy to spend time, getting them up to speed if that's what they want.
Yeah. Yeah, that's great. And I like that approach. I think that makes sense. And we've gotten some arrogance over here in like form, as well as some converts, some that were didn't know.
And actually, Andrew, I think I want to make this point because people see Mike and I, whether it's on this podcast or maybe previously in public, we do have a lot of conviction. We've done the work. We continue to learn. We are students of this market every day. I try to learn something new in this market every single day, literally. We are not resting on our laurels in any way, shape, or form. I'm willing to run through walls every single day as required. That comes with the territory.
I'm too old to run through walls. It hurts, but
yeah. With that said, what people don't see maybe is that if we're poking around, we're this is what we do for a living. We obviously have interest in other markets. We have our own capital, et cetera. So we talk about other markets internally and talk about different stocks and different stuff. Is what people don't see is I do not have conviction on things that I might not fully understand. The people don't see me asking tons of questions to people or poking around. But what you will never see me do in public is have conviction on something I don't know what I'm talking about. And in this era, I don't know if it's social media, I don't know if society or humans have changed in the last, or maybe it's always been like this. I just see too many people with too much conviction without really understanding it. And that is like a massive pet peeve of mine.
I that's a good point, Tim. Can you guys hear me? This thing just went out. Okay, yeah. Better. No, it's a good thing. We are, it's funny, right? I see sometimes we get referenced to the uranium experts. We're not uranium experts. I mean, do we understand the basics of uranium mining? Yes. Do we understand the fuel cycle? Yes. Can we tell you how to convert uranium? Yeah. Like as generic as a lay person as you could find. We understand the math and math, with math, but there's when you come to an industry as an outsider, you want to stay that way and be viewed that way, and that's how we're viewed, right? When we go to these conferences, we know that, and I don't throw that number out lightly, the 20,000 plus hours. It's that plus that Tim and I have spent diving deep and modeling and conversations. And again, we can always be wrong on certain aspects of it, on all aspects of it. We don't think we are, but at least it's with an effort that laying it out in our own minds as to the best way we think we can surround it. But you get to these things, and like I said, you go and speak at these conferences, and these big organizations are willing to put you up as somebody that they respect, and yet it's for us to earn the respect of the people in the business that we still don't have it, and we love that.
Yeah,
right?
I don't even care. I actually
the fuel buyers, the traders. I mean, they know not to go there with us, right? They try, if they're going to have a supply demand discussion. They're going to have both hands tied. It's like they're fighting with both hands tied behind their back. And the same through the fuel buyers. So many of them we speak to several of them, but also several of them will just avoid us. So but that view of being an outsider is wonderful, because we don't care if they respect us, because ultimately, I think they clearly respect our analysis, but that if they don't want to chum up with us, that's fine. because we get access to wherever we want. Same thing with companies. There are, I don't know, 50 uranium companies. We speak to a handful of them now anymore. Why? Because I think what many of them recognized early on is we can be real pains in the asses. Because if you tell us something, and next time we speak to you, we're gonna hold you to that. And a lot of them, like I said, are putting lipstick on a pig. And we know enough to know we're not just you're not going to just pull the wool over our eyes. So how do they avoid that? They stay away. They stay away from that. So there it's a fascinating. It's fascinating. I think the biggest advantage we have is being viewed as outsiders in the sector. We love that. Tim, would you agree with that?
I mean, no question. I'm not even going to repeat it and be redundant because it's spot on, Mike.
Well, look, sometimes it's punishment. I suspect when people have to talk to you, some people, they look at it as punishment. Well, look, Mike, you mentioned, mistakes, et cetera, maybe being wrong. Maybe if you'd just like to share something there, and maybe Tim as well. I mean, is there a place you guys have been wrong, or maybe you can bring something up where you guys have made a mistake?
Oh,
Yeah,
God,
well, one right off the bat from my side and our side, or I guess my side, is I don't think we realized how reliant the sector was just kind of on third-party consultants. It was never a part of the thesis to go rip apart consultants' works, and not badly per se, but just having to spend so much time analyzing other people's works. I don't think, and Mike can comment on as well, that was just one area we didn't really forecast that we would be doing and spending so much time. So that would be a big one right off the bat for me.
I agree with that. That was not part of the. You always look at a consensus number, and as the facts change, consensus numbers typically, when they're derived by Wall Street analysts, they will move up and down with the facts. We didn't anticipate as the facts were changing that consensus numbers didn't necessarily do that. They were shaped a different way. So that was surprising to us, and it wasn't until we really started diving in beneath what you normally need to dive into understanding consensus that we said, wow. So that was one thing. I think the other thing too is the math is so compelling, and when you sit down with people, most markets, when you have price speculators, when you have risk capital at work, the businesses tend to run off of production economics. I think if I had to say one thing, I'd be surprised was by how apathetic the industry participants are in this space. They can't outrun the math at all, and with where secondary supplies and inventory levels are now, I mean, you're right there. I don't say is it, I saw someone on Twitter the other day saying, "Oh, I think it's by next month." What are you serious? Like like really? Or is like, well, yeah, but by April, who knows? I don't know if it's a back half of this year or tomorrow. I have no idea, but they can't outrun where they are right now. So you're really close to them having to do something, but I would have thought they would have flinched a little bit earlier than this, but they're just, and COVID is a part of that. So I appreciate that, but I used to think, Tim and I would say, yeah, well, the balance market, the market balances, 60 plus range, 65, pick a number, maybe depending on 70, who's full of shit on some projects or not, but around that, and you never really need to get much higher, and you don't. But you see the behavior here, and the apathy leads to panic, and they could say anything they want, but history, this is human nature. Human nature doesn't change in these cyclical industries. It's a broken industry. People are scared shitless when prices start moving, and they'll go chase it.
Yeah,
But
maybe one other one that we never forecast, and it took some time for us to figure out. And I've literally never heard this discussed ever. This has never been discussed publicly. I don't think ever that I've seen, and I've searched high and low for it. When Converdyn went down back, I mean, what was that? So late 17, 18, in that area. When Converdyn was out securing conversion, to do that, they would go and buy UF6 and then return the U308, and they wouldn't literally go break it down, but basically somebody would sell Converdyn UF6 and Converdyn would have U308 laying around, and the amount of U308 equivalent in that UF6 is returned to the seller. Well, some of those people that took that U308 back in don't need the U308, so they were blowing it into the market. So this is back in the 2017, 2018 time period when there was more supply, and it was just a total kind of, I don't know how to describe it, a freak accident, or just one of those ricochet events where everyone's like, oh my God, all this conversion went down. And a ricochet event was people getting U308 to lock in conversion, and they were blowing it back into the market, which brought like some supply. We never forecasted that, when we came to the sector, but it was a one-off quirk, and those inventories have been worked through. And now that we're on the other side of this, of all this pain, of all this, headwind that the market's faced, all these headwinds are now turning into tailwinds. So that would just be one random one that, I've literally never heard talk about publicly before.
Yeah, let me step in here, and I appreciate that because that's a really good point. But Mike and Tim, both, either one of you, specific companies. I don't want any names, but have you guys made a mistake with a specific company? I have.
Well, Mike, you're the portfolio manager. It's a good question. Have we made a mistake with a company, just in terms of investing in them or taking big losses, or what do you mean?
Oh, well, Tim, as far as that goes, I'm just saying, basically, look, it wasn't what it appeared to be. We switched and moved on. That type of thing.
Yeah, absolutely.
Yes, absolutely.
Yep. Well, you start very small. We always start very small, and a company might be doing a financing, and you'll give them a little bit of capital, and really we've stopped doing that for the most part, because what we realize is these little tiny companies that you do that with, and we give them X amount of dollars, which is an insignificant amount to our fund, but then they run around as though we're the biggest thing they have, right? So, and they use our name till there's no tomorrow, and next thing you know, people are saying we own it. We're like, yeah, we do, but it's a rounding error for us. But they use it as though it's a launching pad to go raise capital on it. So we've done that, but as you put a little bit of capital in there, and you start to do the work, you start to do the story, and again, you get warrants, so you're willing to take a little bit of a flyer early on, and a rounding error as a percentage of the fund, and then you start to do the work, you start to get a baseline for the management team, and then you realize that sometimes you're like, whoa, okay, we just checked with somebody who knew this project, and that project wasn't right, and okay, we're out, and then you do it. Now, for our bigger core positions, we feel like, you can always be wrong. You never know what you're going to find in the future, but you do it by the time you get them to that, you've done a lot of work on them, and you hope for the best that you've not missed many things. But yeah, early on, definitely. You're trying to figure out who the landscape is, and who the real companies are, and who the CEOs that are full of shit are, and there's more than a few. So yeah, it takes a while.
Yeah. Welcome to the junior natural resource sector, no doubt.
Yep.
The perversion goes deep, I can tell you.
Yes, it does.
Mike, just on this part of it, just as we go through here, there's maybe a 2 exit strategy thought here, but maybe you could just offer the audience, and I know this is sensitive, but just be vague, but how is the exit strategy for Sachem approached for this sector? And then lastly, will the Sachem fund be closed, or will it continue with other opportunities in the future?
It's very, the buying's the easy part. That's a no-brainer for us. Like in uranium, it was. It's always the exit that's the hard part, because you're then balancing. When you're in a sector early, you're then balancing what other people are coming around to that you already kind of know. So we look at this based on fundamental valuation. What's the net present value of the project? What is how are people going to look at this on a multiple of free cash flow? There's also going to be a lot of people who look at it in a lazier way, that EV per pound in the ground, because that's easy. A lot of those pounds might not be worth anything, but you look at it there, and then that's the more science part of it, and then there's the art part of it, which is okay, people are just now wrapping their head around it. And like I was referencing earlier, all of a sudden they're like, well, maybe we shouldn't use a 12% discount rate. Maybe we should use it 8, 7, whatever, making up numbers, whatever people are going to choose. Or all of a sudden they'll go back and point to the prior cycle, and all of a sudden the multiples will become much higher. And so, and then there's just FOMO, fear of missing out. People pile in, and you'll see the stories, and that's where we'll gauge as to what the promotional level is if we're fortunate enough to get there. Right, first our thesis has to fully be correct. So far it's playing out, but if it continues to be correct, like we hope and think it will be, then it's a matter of adjusting as to where you are. There's that portion of it where you look at it on certain names and say, okay, you know what, it's at a point where it doesn't deserve to have this percentage position in our portfolio. Maybe we should sell it down to a smaller size based on risk reward, right? Because it's position sizing, right? You still might like the company, but the upside might not be as much. So therefore, it should be a smaller position, whatever company that is, whatever. It's all valuation work. But then there is that FOMO, and that's the tricky part. What we probably and we tell our LPs this, our investors, we're probably the guys who are going to be more cautious than not. We really try not to get caught up in the hype, but we have to be cognizant that whenever that time comes, we think you're still in the first, second inning, but whenever that time comes where you're in the 7th or 8th, we have to recognize that for some people, that's the second or third inning to them. So you don't want to sell too early, but you don't want to have something that's completely not based on reality. But again, and that will adjust as time goes. You'll see what happens. Where's the price of uranium go? That's a big part of it. We don't know. We think we know where it has to go, but where will it ultimately go? It's probably, we would argue, based upon it probably goes higher than we think it needs to go, but who knows?
Yeah, and it goes back to just, playing the cards that you're dealt, right? When I approach the market day to day, I like to think of, kind of, for me, kind of a 6 to 12 month rolling view. So as you're rolling through time, it's always that 6 to 12 month forward view, and what information is coming in, what's changed, what's new, what's sentiment like, and that's a lot of the art to it, right? So that's just kind of how I approach it and look at it, and just, hey, what's changed? Is the risk reward still there? How have the stocks reacted? How has the physical reacted? What's going on in the fuel cycle? How does that continue to react? So it's all those pieces, just putting the puzzle together and letting the picture tell you what's happening, and to take whatever your value system is, whatever your views are, and go from there.
Mike, and does the fund continue after this?
Yeah, it all will whenever that time is, who knows? You don't know. Whenever the uranium investment has gotten long in the tooth, like all cyclicals can, whenever that time is, only to the extent that there's another interesting investment idea that has the same asymmetry. We'll keep I would imagine, I'll keep our own capital in there, but I don't. Deciding to run money for others on the outside is really, for us, what's interesting is only when there's something that we think is asymmetrical, and something where we think we offer an insight that is not available in the market, a variant perception, and those are really hard to find. You see a lot of guys who have really big trades and then they continue to think that they could keep doing it, and that doesn't really happen. They're hard to find, and to just go along, and I wrote this in our letter that we just sent out, was, why do we invest in this style? Because investing in where people with much more resources than us, with armies of people, with tons of capital, a lot more capital, of course, than us. How are we going to get a competitive advantage over them? We're not. And oh, by the way, they don't have a competitive advantage over themselves, because most of them underperform. So why play in the same sandbox as other people? We just go look in desolate hunting grounds, even to the point where the hunting grounds are such where many perceived value investors have gotten burnt. and it's, the old once bitten, twice shy, where they thought they caught something, they were really catching something in the early stages of a downturn. Then we become interested. So it could be, I don't know what that it could be, but we're always, we're 24/7 uranium, but we always are poking our nose in at other things to see what's interesting to us.
Yeah, and we have a lot of advantages being small groups, small capital, and also, these big groups with these huge teams. Sometimes I think that's actually a disadvantage just because of the noise of the group size. Tim, talk about how Mike picked you up off the street. How did you guys meet? What happened there?
We met, we actually met because of Twitter several years ago. Someone in his town was tweeting that he was going to see the uranium bull or the uranium god, whatever it was. And at the time, I had been poking around the space myself, and I literally knew 0 other people on Earth looking at uranium. And so, long story short, kind of figured out who he was. I reached out to him, said, "Hey, I saw you're looking at uranium. I'm looking at uranium. I'm a physical trader. Yeah, there's something going on here, and there's a lot of blank spots that I have. I've only been looking at it for about 6 months, but something is interesting here." And we just kind of started a conversation, just started going back and forth with looking at some stuff, and just with no intent to start. I had no idea that this was going to evolve into a fund. I was just investing my own personal capital, and we just kind of started doing some research together, and one thing led to another, where we were like, okay, there's like really something here. And given Mike's background with being in the hedge fund world, he was like, hey, I think I want to go start a platform and a fund here. Would you want to join me? And I said, of course. There's a lot of smoke here. Let's see what we can do. And that's kind of how it went.
That's great. And Tim, how important, you guys mentioned net present value. We certainly use it here for multiple sectors, but how important is it right here? And as you guys know, net present value is 0 for a lot of these companies at this stage.
Yeah.
But in your analysis of the sector equities and outside of that, maybe what's another meaningful metric that you guys like for this sector?
It's a good question. Well, kind of like Mike said, there's a couple different ways we look at it. There's the lazy man's kind of just, enterprise value to pounds or enterprise value to M&I. Net present value is, look, one of the tricky things about net present value, of course, is it's really dependent on your inputs, right? Depending on whatever your inputs are, you can kind of get whatever you want out on the other side. So it is dependent on, the discount rate. What prices are you using for received sales for the companies? What is their actual production schedule going to be, and what are their pounds like? How much depreciation is involved? So yeah, those are all important metrics that we want to look at because we want to stay grounded. We also have gone back and looked historically just at what things have traded at. We've mapped out going back to companies last cycle that were around, just taking a look at just as a baseline to see what were investors paying for an EV to pound in the ground, an EV to M&I. Were these companies generating cash flows at the time, and what were investors paying for them? So, there's a couple different things that we look at from that angle, both, presently of what our inputs are to some of the models, as well as just historically where some of these companies have traded in the past.
Yeah, no, that's good. And for some of these companies, just a little bit of comedy, you can add the limousine and party metric to it as well.
Correct. The FOMO factor, as Mike likes to say. Yes.
Just vaguely, and good points, Tim. Absolutely, there's all of those should be looked at. And vaguely here, Mike, maybe can you just mention the general, Sachem strategy and general view of approach in terms of specifically just jurisdiction and maybe the company's stage and how you guys have mixed up explorer, developer, producer.
Yeah, to the extent we're a large shareholder in a couple of companies, so you could probably see it. You could look at the filings where we have to file on some of them. I won't talk about them, but you could see. Look, we get how there can be some wonderful exploration companies, and there are some really smart natural resource investors that are far greater skilled at us, because Tim and I are not skilled at finding exploration stage companies. We do have geologists that we can consult with, but the success rate is not great. But there are some that are really wonderful. I've never met him, but Warren Irwin clearly had a wonderful call on NextGen, right? Early on, before he was predicting that would happen. That's not our knitting. That's not what we do. We the way we come at this, having over many decades looked at natural resource companies, knowing what we're, at least what I'm good at and what I'm not good at. So for us, it's really being able to identify a mismatch in the macro, where it's just the consensus macro is dead wrong. And then how can we play that's within our comfort zone and that works with how this cycle is, right? So we know that, how do we think it will happen when there are some mines on care and maintenance that don't require a tremendous amount of startup capital to get back up and running, that will be part of a contracting cycle, right? So there's, Andrew, it's important, like, to put contracting in context. People say, oh, so-and-so, they might, like, you might hear in the future, or you might not, but, or it might happen or it might not happen. So-and-so signed a long-term contract for $35 a pound. Oh my God, they all need 50, it's 35. No, that means nothing. You don't care where the lowest cost guys sign. You care where the marginal producer signs, because the lowest cost guys can only fill in bucket one, the first lower tiers of that bucket. When they start contracting in mass, it's where the higher price guys need to sign. So there's that bucket that's filled. But so the way we kind of look at it is okay. We like some of the producers that are on care and maintenance, because we think they'll get. They don't need a lot of capital, relatively speaking, to start up again, and they'll generate cash flow, and the market will be attracted to the cash flow, and so that is something that's a higher priority for us. And then on the development stage companies, there's just a couple of assets that we think are just world class. We didn't reinvent the wheel there, by the way. Where we just think that, the market is going to pay, and when this cycle turns, the market's going to pay a significant amount more because this asset is just too good, or these assets are just too good. And so that's kind of how we think about it, where you will not see a lot, and we do own a little bit once in a while. We'll have a couple of exploration stage companies, just because that's not our thing. And fine, that we know that's where you can get the monster returns, but we're very content with sticking to what we can understand. We can understand an existing producer. We can understand a mine that's on care and maintenance, and then the work that they're going to do to come back. We can go to our mining engineers. We can go to our geologists and ask if that makes sense. We get that. But poking a hole in the ground is not our strength, so we stay away from that. As far as geographies, it's for us. It's not necessarily the geography itself. It's the geography and the experience of that geography with the commodity itself. So, has this commodity been extracted there for a long period of time? Is there a history? Is it important to the state revenues? Will they protect this industry? Will they not? Is there a history of changing tax regimes? So it just kind of all depends. Everything's commodity specific. In uranium, I would say we've got a little bit of everything. We're not big. We're not big on statements, on buzzwords, on catchwords. We're very clear. We're a couple of outsiders, proud to be outsiders to the industry, that have a differentiated macro view and stick to some basic knitting on the companies, recognizing that there's many ways to get hurt by owning junior mining companies. So we try and reduce that as much as possible.
Indeed. Yeah, absolutely. And Tim, just following on to this, getting into a little bit more discussion here about, supply, demand, and profiles, et cetera. But there has been recently some concern with NextGen, a developer, crushing the market with their big production short mine life under their current proposed mining plan. Now, I struggle to see a strong impact with Cigar and MacArthur really being meaningless during this time frame that I'm talking about here. And of course, I question the time frame, and of course, the question or the price at which that comes in, and when that decision is made. But what are your thoughts on this? Certain companies will crush the market, and what do you see as a real time frame for something like a Arrow deposit to actually be in production?
In terms of crushing the market, I just don't think that's going to happen. We've talked to, all the management teams, out there. They're the people that have, solid development projects. They're very aware of their impact potentially on the market in the future. They're smart. They want to maximize shareholder value. There's no question about that. In terms of when do we think specifically things will come on? I mean, look, Arrow is a generational deposit. It's a fantastic a deposit in northern Saskatchewan. Look, they've got to go through their permitting process, which they're working on heavily right now. They've got to come out with their updated feasibility study, which they're working on now, which will be coming out, at some point this year, first half of the year, maybe this year. So we'll see what they say in those updated reports. But am I worried that a producer is going to come on and crush the market? I mean, the fact is let's say theoretically, let's just run a very theoretical example that a big deposit like Arrow were to come on and that they were going to start selling into the market. I mean, that means that a lot of things have gone right in the uranium macro market. That means that obviously the permitting stage has gone well, and they've gotten that taken care of. It means that they've got a bankable feasibility study. It means that they probably have signed some contracts to underwrite the financing of the mine itself. So,
Right.
The way that we look at it is it's kind of inverted again. I think for projects to come online, that means a lot of things have gone very well in the macro market. And by the time those things happen, whether you believe it's 2025 or 2027 or 2030, that an asset like that might come online, that means that the stocks would have probably already re-rated, and the current opportunities that might be available today are likely not going to be the same risk reward then.
Yep. Well stated. Well stated. That's excellent. And very much alignment with my view on it as well. And we'll get into the some more of that discussion about, global resumption of existing capacity in just a moment. But Mike, I got to ask you one. This one's a little bit silly, but what is your view of promotion by the listed companies in this sector?
It's a joke. Unfortunately, it's not a joke. It's not just uranium; it's all junior mining. It's look, I get that you have to be a wide-eyed optimist, right? To say, okay, I'm going to go find something underneath the surface and I'm going to go extract it, but that lends to a lot of snake oil salespeople, and not all of them. There's some very good people that I've met, but Tim and I, more often than not, shake our heads, and we, as I see you asked earlier, do you make mistakes? Well, you try and limit them, and you do it very as you're learning a whole sector of companies. But you see things, and you see things about the costs and how they change their focus, and they shift, and this what it was ago is now on iteration. None of their 3 iterations have come to fruition, but they get a new crop of investors, or they convince the old crop of investors that there's a new thing now, or there's a new twist on it. And it's stuff like that where we just say, what, WTF? And you see that, and it's pretty rank. It's nasty, but it happens. It happens. We're not the police on that, though, right? We're not going to sit out there on Twitter and bang out who we think is good or not. It's just not our thing. And it's I don't have this, truthfully, Andrew. It's a weird. The whole social media thing for me was weird. I'm a dyed-in-the-wool introvert. I did the podcast, just being who I am, and I was uncomfortable with the inbound attention that came from it. So we kind of stopped it, and it was very time consuming. But this whole it's a free for all, right? People can say people hide behind names. They get nasty. Civility is lost, and so I've just personally chosen to not go down that rabbit hole of which companies I think is bad or not. I can't help. People got to do their own work.
Yep.
But the promotion is stunning, and you see how sometimes they will use people in the industry, or not in the industry, that's the wrong term, but they'll use people to promote themselves in many ways sometimes. And it's and a lot of people are just unsuspecting, and they may not recognize it, and you just say, okay, that
Yeah.
won't work. So long-winded
Yeah.
answer, but it's a weird junior mining is a weird space.
Good. Yeah. Good points. Do your own work. You got to get them sorted out, and that's going to continue. And it happens in the entire natural resource sector, as you stated.
Yep.
And, instead of Ben and Jerry's here, we got to rename Sachem Cove to Mike and Tim's Yellow Cake Factory and Cannery Co. I think that's. Well, okay, guys. Tim, just another question here, and we're getting through here. I really appreciate you guys taking the extended time. This has been a fantastic discussion. Tim, do you see backwardation occurring for a time in this sector, like later
No.
stage spot price
No.
exceeding long-term price? Okay.
No backwardation. Well, so theoretically, the market quote unquote got backwardated very briefly for a moment, but that was skewed because of location differentials in April and May. If the market's real and the forward curve is real, backwardation is almost impossible in this market right now. And the reason why that is because there's so many pounds locked up in carry trades that if the market flipped from contango, where the forward curve is always rising, to backwardation, where it flips and starts trading at a discount in the future, carry traders would simply unlock the pounds that they have in these carry trades, sell them into the spot market, then go simultaneously buy back pounds in the forward market cheaper and put them back into the carry trade. So I don't see how a structural backwardation would happen anytime soon.
Okay, very well. And later stage, do you see spot exceeding long-term at some point and so forth?
It's tough. It's too tough to know. There's too many variables. Like I said before, really focus on that 6 to 12 month view. Once you really start getting past that, it gets really foggy, and I'd just be completely guessing. There's too many variables from both the supply side and how behavior of utilities would be, alongside with potential financial interest, and not talking the traders in the industry, but hedge fund interest, institutional interest, buying physical. There's just too many variables at play to even potentially predict how that could go.
Let's assume there's no growth in our data, and let's make the assumption that utilities don't restock to their historic levels as they did in the past. Call it a 5-year average inventory for purposes of this question. And they use a smaller and shorter supply contracts at your average incentive price, which will allow existing global capacity restart. Do you see a balanced market at that point under these assumptions?
I think it'd be tough. New mines need to come on. That's a good question, but I think too many pounds are just coming out and too many mines are being depleted right now.
Yep. This is not despite what was said publicly by one of the companies that it's an incumbents recovery. It's not. You need new mines. That there is no doubt. I mean, go reference what Riaz said. Riaz Rizvi, who left Kazatomprom, the chief commercial officer, was a really sharp dude. Riaz said you need two of us, right? And we've spent a lot of time with Riaz, a lot of time, and have shared over the years our modeling work, and these guys are smart, and they said you need a couple of new Kazatoproms, and you do. So no, it's not one of these where you just because these are long life projects that require a lot of capital, that require time and permitting, and you need prices to move. It's all price dependent. Price has to get up there. So I don't know. There's nothing about this uranium market that goes, oh, okay, well, we're going to move. If this guy does that, that one's going to happen. It's going to come around balanced. Bullshit. It just doesn't. It's not going to. We don't view that as happening because of the broken market structure, the lack of the curiosity by the buyers, the traders with no balance sheets. It's like, boom, they're going to get smacked in the face. They're going to run. They're going to go try and get pounds, whether it's, everyone has this theory. It's going, oh, They're going to come in the short-term market. You know what? They're going to panic is what they're going to do because they've done it before. And they could sit there and we talk to them and they'll say, oh no, well, we're going to be disciplined. We were talking to this trader the other day and he said, well, when prices rise, the utilities, they'll just step out of the market like they did last time. And we said, I'm sorry, what? He said, well, like they did in the last cycle when prices were rising, utilities didn't contract. I'm like, dude, what? You joking, right? Like, have you studied the math and the contract data? No, they were tripping over themselves. The same guys who wouldn't sign and ladies who wouldn't sign contracts at $20 were begging to sign contracts at 60 and 70 and 80, right? So nothing about this market because it's so dysfunctional will be smooth and transitional. It will be like boom.
Yep. Yeah, I think you hit it squarely there. I think that's correct. And my calculations certainly show that, no doubt in my mind, that new development projects, select development projects, must come online. Absolutely. And I want to couple this with another question. And you mentioned phosphate first on here in the discussion. But when uranium prices do improve during this cycle, Mike, is there any thoughts on some of this, uranium extraction from phosphate? Do you see that at higher prices that this could become a potential secondary supply?
I mean, way down in the future. I mean, I don't even bother myself thinking that, right? So Tim and I don't spend much time on that because the price is going to be where it's going to. By the time the Brazilian mine gets financed and funded or whatever it is, this shit's down the road. It's just like people worry about people sit there and poke at the next cycle, the next technology. What about seawater extraction? Okay, dude, they've been talking about this forever. I mean, all this shit comes out. The reality is these are look at what's happening in some of these highly shorted names. You want to see what happens when markets react, right? I mean, it's the animal spirits take over. So, could it be? Yeah, but look, anyone who thinks that they're going to become a 20-year uranium investor is in the wrong trade. It's not going to happen. Prices are going to boom. You're playing a greater fool theory, right? You're finding a mispriced asset. It's really mispriced. It has to rise meaningfully to get to the marginal cost of production. Otherwise, the demand will not be met. Unless it gets there, demand will not be met. Reactors will be shut down. When it gets there, it will overshoot. And then somebody's going to come along because they're late to the game and dream a new dream. And they're going to sit there and say, well, look at this. Prices can get to one. Well, really, prices should start at 150 or make up a number because that's the next crop of people that are going to come in. That's a narrative that's taken over. We'll be long gone.
And the world is already trying to, and it's awkward because the market and risk capital that's coming in to get positioned for everything is in equities. So we've seen equities go up recently over the last few months. Yeah. This is the market coming to the realization that pounds are needed, that prices need to go up. And the equities are beginning to price this in because institutional investors are beginning to see the writing on the wall. Now, whether the utilities believe that or not, or are going to do that or not, doesn't matter. The point is there isn't a mechanism in the physical market to allow that price discovery, but it is trying to be delivered in elsewhere.
And don't forget, Andrew, as people are coming into the space, institutions are coming in. And in our perch, we see it with as we were talking about earlier. There's only a very limited number of companies they can invest in. Because of the size of most funds, even a $250, $500 million hedge fund or bigger. If they're going to express the view, you're running $500 million, you're a generalist hedge fund, you really like the thesis, it makes a lot of sense. You're going to put 10% of the fund into the thesis, that's $50 million. Well, there are very few companies and you're not going to own one, you're probably going to own a couple. The companies are too small, right? So even for those, then what starts happening is the bigger funds start to recognize this, and you start to see it permeate within. We get, because of just being around the industry for not just uranium, but an investor for 25 years. I have people call me all the time from investment banks wanting to come in and talk to us and tell us this, and now they're getting up to speed on uranium and so on and so forth. But when the bigger funds start coming in, well, they can only express that view in so many ways. So where do they look next? Different ways to express the view. Right? They'll recognize and are recognizing the supply-demand dynamic. Right? They're recognizing the ESG role. If some of them might have a view that that dollar gets weaker, commodities are mispriced. But the point is, it's not just the equities, and there's limited equities to play it. The next stop is physical uranium. and what the utilities and what the traders and what they don't price in, and happened last time too. In the last cycle, physical funds bought 40 million pounds of uranium. What they don't recognize is that pretty soon the choice could be taken away from them as to when they enter the market to start buying, because it takes one fund, one physical fund, to decide they're going to put a few $100 million to work, and it's good night, Irene. It's done. Game, set, match. And so, again, though, they will be asleep at the switch on that. Why? I don't know if it's an apathy or an arrogance or what it is. Not sure. But that's what our view would be. You should always protect your flank. And we don't think there's a lot of flank protection.
And here's the other thing, Andrew. If utilities didn't think prices were going to go up, wouldn't they be thrilled to sign market reference contracts, long-term contracts today? Because they can do that. They can approach producers and sign market reference contracts for the next 5-7 years.
Yeah.
Why aren't they doing
will
that?
sign those. Cameco will sign those all day long. We'll say,
Why
let's go.
won't they do it? Because they know they're going to get run over if they do that. They're trying to get, base escalate. They're trying to get, these fixed contracts because they recognize the dynamics here. They're not dumb, but, for whatever bizarre incentives, they're just, and again, the fuel cycle, we talked about it. So they'll take their time and they'll do however it is, whether it's a month or 12 months, or maybe Mike's right. Maybe funds come in and their hands are forced, but either way you dice it. If they were not worried about this market, they would be signing market reference contracts all over the place instead of doing carry trades, locking in prices. Because carry trades are just fixed forward prices. Effectively, they're locking in a price, and that's that.
Right. Yeah, that's fantastic, and that's a great point. And look, it's a classic supply squeeze. That's all it is. It's a classic squeeze. And so this is fantastic where we're sitting today in the market. And then, look, it is forward looking, as Mike indicated. It will become more forward looking. And then, of course, it's just the crowd comes in. Like you said, the funds will come in herds, retail will come in herds, utilities will come in herds. Yeah. And then when you look at the incentive price of $50 or 55 or 60, in some cases 65, 70, and some of the crappiest projects that need really high optionality, the fact of the matter is once you start those decision processes of restarting and doing new mines, you just started the clock of 12, 18, 24 months, permitting processes, restart process, construction, add 2 years construction, 3-year construction, 4-year construction, and then the whole fuel cycle on the back end. It's just forward looking. That's an understatement.
Right, exactly. And Andrew, you brought up a good point, a lot of good points there. Once it starts kicking in, it takes on a life of its own. The question earlier was, if they don't, how contracting looks. Well, it all depends, right? They've been contracting at mid-30s% the last 7 years. Do they decide they're going to run back to 100% of their annual consumption right away? Maybe, maybe not. But once they get past roughly half of their annual consumption, right, depending on what your number is, once they start to get past contracting for half of it, then you immediately go to the marginal cost of what's the marginal cost of production. The first half of those contracting, and this is so important, that can be filled by the Kazakhs, by the high costs, and the Kazakhs or the Russians or no shit. It doesn't, right? So if utilities continue, they're going into their 8th year of contracting in on average mid-30s% of consumption, which is like almost unprecedented. In the bull market, they were contracted at 150% of consumption. So if inventories are run down and they're under buying, you just got to remember when they start buying to that above half of it, because the Russians and it doesn't matter what they sell it. I don't care what they sell it at. Of course they can sell it cheaply. That it doesn't matter. It's what's the marginal producer sell it at, because the forward curve today is not priced off that. The forward curve is priced off today's interest rate plus a little bit of interest rate going forward. It's not based off marginal cost of production. Think about that. Think about what a sophisticated hedge fund could recognize when they come in and they want to structure products and trades based off of an inefficient option market.
And to take it a step further, just to show you that they do care about these production facilities and these mines, 3 years ago, they couldn't care less couldn't have cared less about conversion. And now, what do you hear? They're anxiously awaiting whether ConverDyn is going to be restarted or not. Hello? What, you think these mines are in any different situation than ConverDyn were in? So 3 years ago, you couldn't have cared less about that facility. Couldn't pay $5, $6 for conversion. And now you're anxiously awaiting to see if they're going to restart or not? That tells you, A, their thinking is way too short term. And B, how do you think these miners feel? Okay? Like, you have to buy this stuff. There is no substitute product. So their behavior, the way that they look at this market, the way that they want to support these production facilities will change. I guarantee it.
Beautiful. I think they restock in a big way. With COVID, it's about back to the comment earlier about just-in-time inventory versus just-in-case.
Yeah.
So, Mike, talk about the market impact, and this is another audience question here, and this is forward-looking here with the impact of the SMRs. Do you see that these will really be built in the second half of this decade? And do you see that this will play into the thesis mid-late stage?
Maybe. Sounds good. Good story. Makes sense. Could be they get funding. They'll get funding. It would be a good part of the narrative. You could use them. It's a compelling case. Will there be uranium needed for them? Yes. Will it be monumental? Probably not. But it just forwards the nuclear power story. Tim, you have a different way of thinking about it?
Yeah, the exact same thing. I mean, I'm hopeful as a pro-nuclear advocate and clean energy advocate. I hope SMRs do become part of the global landscape. It's certainly not priced into our thesis in any way, but I am hopeful, just as a pro-nuclear person, that these reactors are advanced and can help the global grid.
Yeah, agreed. And I think it's time to take these PWRs that have been operating in certainly nuclear submarine applications and maritime applications. It's time to put them out, commercialize them. Makes a lot of sense. Certainly not factored in, but I think it can have some teeth as we get going and they actually first get deployed. And given the amount of companies and capital and names that's being attracted to this particular segment, I do think that this will get done. On what scale, I don't know, but I do think we'll see a couple of them come about. Let's move on here. An audience question and just really a statement, and I quote now, please ask Mike and Tim about how they feel giving anyone who wanted to listen the opportunity for life-changing investments. How one plays the cycle is up to every individual, but thanks to their work and their willingness to share, the opportunity was created. So just a quick thank you from the early retail club.
That's awesome. That's great.
That we love hearing. Yeah. I mean, that's, why we started talking about it publicly because we thought there was a disconnect with fundamentals and stuff. I mean, I'll be perfectly, I can't be more clear and honest in this. I've backed out because it becomes too much. Like it's, when you become a little more, I'm a nobody, right? I'm just a guy who knows how to pick stocks sometimes. Sometimes I'm good at it, sometimes I'm not, but been more good than not. And I tend to get it right more than not. But the the guy or lady that are sitting there trying to learn and make a big difference. I mean, that makes it. That's everything. I spoke at a couple of conferences and some people came up to me and stopped me in the hallways and it was funny. I was telling my kids then, they're like, you? Like, are you serious? And I was like, yeah, I know. Right. And then I was doing the podcast and it was uncomfortable. Because it was just no different than anyone else. Just happened to know how to put a model together because I've done that before. But it just gets, that's very nice to hear. It's when you start to, but it's when people, you start to open yourself up more to it. And, look, I'm just a regular guy and a dad that likes to go home and have dinner with my family and put my head on the pillow and wake up the next day and do it again. Then you kind of expose yourself to this whole world out there. And that's more than and I didn't know that. I didn't know what it was like doing any of this stuff. I think Tim at one point, so hang on. Hey, I'm sorry. Tim just texted me something that was very funny. Anyway, so thank you. It was very nice to hear.
No, It's really nice to hear. And look, I mean, we obviously hope we're creating value. We're creating value for our investors, for other people out there. Hopefully, they're able to do work as jump off points, like we've talked about before, and hopefully they do well as well, too. So that's a very kind note from that listener.
Yeah, and just to finish up, to do it justice, so just a quick thank you from the early retail club, not those that are now shouting out there, etc., but to those who were quietly accumulating for the past years.
Yes, and Andrew, I get some DMs from some of those people, and they really kind, nice people, really very thoughtful. It's and there's some newer ones that are very nice too. Again, I don't check it a lot. Every couple of weeks I might pop in or something, but. Well, wow, I'm getting a call right now from the New York Islanders. That's pretty cool. Only because they want to sell me. They want to sell me tickets. That's all. But yeah, yeah. Anyway, there's some really nice people.
Yeah, and look, I'm surprised you still have your direct messaging actually still turned on. I'm surprised.
I don't know how to shut it off. I don't know how to. If I knew how, I would. I tried, and I can't figure it out.
I'll bet you there's messages that come across about how to do it now.
Probably. Yeah, because I don't know how to do it. I tried to figure out how to shut that off, and there was a time, Tim got off of Twitter. He just had it, and I was going to too, and I said no, because if to the extent anyone cares, people probably don't care, but they would say, oh, they don't care about it, which is not true. I mean, this is our highest conviction ever in the thesis, but it's just for me, the platform isn't that been it's just it's outlived its not usefulness. That sounds wrong. It's just something that it creates more noise for me than anything else.
Yeah, you definitely got to turn it off, and it's a hard lesson to learn. But I think we've all accumulated that discipline over the years to be able to turn this, shut this crap out.
Yeah. And again, by the way, there are some wonderful resources on there for people, right? That people do a really great job of it, and they keep everyone informed. That's wonderful. It's not my thing. So.
Yeah. And I'll take closing comments here in just a moment, but wrapping up here to our audience, thank you for taking the time to join Mike, Tim, and myself. We appreciate the relevant questions, contributions coming from Aaron M. at Uranium Investor, Benjamin H. at Belgium Bull, Dale H. And if we've missed anyone, forgive us. Unfortunately, we're not able to get to all of the questions just for the sake of time here. And if you're not a SmithWeekly member and have joined us for the first time on this event, make sure you check us out on our website, smithweekly.com, and also via Twitter at SmithWeekly. We appreciate any comments, questions, feedback that you might happen to have here, and you can reach out to us using the contact information shown on the screen. And to wrap up here, Tim, tell the audience how all this ends.
Man, I wish I knew. Unfortunately, my crystal ball was dropped a long time ago and shattered on the street. But look, again, it's that 6 to 12 month forward view. We're really curious to see as we get into the later first quarter here, second quarter, just how kind of utilities are working their way through the fuel cycle. It'll be really interesting to see what kinds of RFPs come out, what periods of time utilities are looking for coverage rates, and in what form. Are they looking for EUP deliveries, only, where someone's going to have to go out and source all this material and get it through the fuel cycle? Are they going to be doing EUP and UF6? Are they going to be doing EUP, UF6, and U308? So it's important to look at the product form of RFPs that they're interested in. It's a very important to look at the volumes and the time periods that they're looking for coverage at. And we'll just kind of take that information in as it goes. And, unfortunately, while it is, it feels like we're turning a corner a little bit here with COVID, vaccine rollouts are going, which is wonderful to see, to all the people across the world, the frontline workers that have been working their tails off for 12 plus months now. Unfortunately, in certain parts of the world, it's just still very uncertain. We don't know how things are going to affect operations in northern Saskatchewan. We're not sure how things will continue to affect things in Central Asia. So we're waiting, just like everybody else, trying to understand the pieces to the puzzle. weighing the risks and the rewards and the odds of things happening. But that's what we're paying attention to.
Yep, absolutely. And I think we're all here, especially the three of us on here, are still here to write checks if needed, and the market conditions allow. Mike, final comments to close out.
Thanks for having us on. It's just keep following the fundamentals, and they'll eventually take you to where you think you're going to go. I know we're happy with demand. Demand is a little bit better than we thought it would be. Supply is better than we thought it would be. Inventories are down. Secondary supply is under control. Contracting needs to be done. If it's today, tomorrow, or the next day, who knows? But I'd rather be on our side than be a fuel buyer right now.
Well, gentlemen, let's leave it there. It was great to have you on, and I know our audience is much appreciating this chat we put together for them. This was a high quality discussion, and thank you again for taking the time to share your insights and wisdom with us. I want to wish both of you well and an open invite to come back and chat in 2022. And on behalf of our guests in Smith Weekly, stay well. Good luck out there.
Thanks, Andrew. We appreciate
Andrew.
it.
You too. Please stay well, and wish you and your family well in 2021, and all the listeners. And thanks for having us.